Good morning. It is Friday, December 23rd. Can I say it's Christmas Eve yet?
Yes, go.
Now I can say, I got the go-ahead. This is Yahoo Finance Live. I'm Julie Hyman. That's Brian Stassi. Brad Smith has the day off. And taking a look at futures here this morning, we have quite a lot of oscillation here. And that's after we got some data this morning out for the month of November from the federal government saying that we saw spending sort of lackluster, even though incomes picked up. The personal consumption expenditures deflator, that is the measure of inflation watched by the Fed, that did come in, pretty much in line with estimates, showing still a deceleration.
And another dreary read on the pace of consumer spending. We had that retail sales report a couple weeks ago that tanked the market. Now this, again, all indications this holiday season just did not live up to expectations.
Yeah, perhaps not. A quick check on the 10-year note as well, and there we see the yield at 3.71%, moving up a little bit as we got those numbers.
All right, now here are the top three things you need to know as the clock hits, 9:01 a.m. Holiday travel this year gets a whole lot harder as bad weather across the country has already caused over 5,000 flight cancellations. We'll dive into more on what this means for the airline industry. And is Elon Musk asleep at the wheel? The Tesla CEO takes to Twitter Spaces to say he won't be selling any more shares. This comes as analysts continue to slash Tesla's Q4 delivery estimates. We discuss.
And Santa Claus, a sell-off on tech stocks. The sector set for one of its worst Decembers in nearly 2 decades as companies like Amazon, Apple, Microsoft, and Micron have erased November gains. We'll break down what this means for investors heading into the new year.
But first, it's all about the weather today. And as you are gearing up to head out to catch a flight or preparing to host this weekend, you may be getting hit with delays or power outages. And Julie, these are really starting to, let's just say, pile up. I saw, 10,000 flight cancellations yesterday?
Yes.
That's huge. We're not seeing the airline stocks really move a lot on this, but this is turning into full-on holiday travel chaos.
Yeah, I'm just clicking refresh on the FlightAware site, which shows right now total cancellations in or out of the United States today, just over 3,400, with delays standing at 1,700. So 1,700 delays, about 3,400 cancellations straight out. And obviously, this is a big issue, as we know about this weather system, causing frigid air here in the Northeast. It's still just rain, and then we're going to get a deep freeze that presumably is going to cause some other issues on the roads and potentially for power providers as well.
I haven't seen any economists, Julie, come out today and slash their fourth quarter GDP estimates on this. But nonetheless, of course, a key consideration to watch as people travel and go out there and they theoretically during this time spend money and support the economy. But again, they can't do much if they're stuck in an airport.
Yeah, because of the timing of this storm, it doesn't seem like it would have put that much of a depressive effect on last minute holiday shopping necessarily, right? And people can still try and order things But, so yes, we haven't seen anybody coming out and cutting their estimates. I'm also looking at a separate map that takes a look at power customers around the country and where we are seeing people with the lights out. Because even if this isn't necessarily going to have a big material effect on airlines, although it still could, we're going to talk to an airline analyst later in the show, could it also have an effect on some of these power providers? And we do have a number of states that have at least 10,000 customers who are out of power. It looks right now like North Carolina has one of the higher numbers, along with Texas, as well as Georgia and South Carolina. So that seems to be where a lot of the outages are concentrated.
Yeah, I'm also looking at what's happening in the commodities markets. Not seeing anything too crazy per se. Seeing crude trade about $79 a barrel or so. That's WTI crude. Something to watch, of course, is grains. We had Sal Gilberti on yesterday from Tucreum talk about might see a spike in wheat prices because of this storm, but not seeing any wild moves just yet.
Yeah, and our intrepid colleague Brad Smith, who was meant to travel to Ohio, I think they just pulled. I think they pulled the plug. Oh. I think they pulled the plug on that trip to not even attempt to go near an airport today,
that's why he's a value team member. I mean, he just gets it.
Makes the wise decisions. Speaking of wise decisions,
Elon
Musk continues to be a talking point as the Tesla and Twitter CEO took to Spaces last night, Twitter Spaces, to say that he will not sell any more Tesla stock for another 2 years. He said 18 months, 24 months. This comes after Musk sold $3.6 billion in stock last week, bringing his total sold over the last year to almost $40 billion. And let's be clear here, his credibility is just about nil when he says he's not selling more stock, because he has said several times, notably in April and August, I believe, that he wasn't selling more stock. And then he went ahead and sold more stock. Part of that related to his acquisition of Twitter. And he also just says he's not feeling great right now because of the economic backdrop. And that's been part of the reason why he said he's been selling stock.
Nothing like hearing from Elon Musk saying he is expecting a severe recession or economic slowdown really 2 weeks before they're supposed to announce delivery estimates, which is a major red flag. It's almost like he's giving you guidance real time. And to that end, friend of the show, Dan Ives, out with another one of his Tesla notes, which I continue to write up. I have that story on yahoofinance.com right now, saying Elon Musk is asleep at the wheel of Tesla. And I think Dan is now coming around to this view, and maybe not some others on the street just yet, that maybe Elon should also take a back seat at Tesla. If he's going to be that focused on Twitter, maybe he should get a more of a focused CEO at Tesla, more of an automotive guy to run that company as well.
I mean, he did try to reassure investors on that front as well during the Spaces. He said he hasn't missed a single important meeting at Tesla. He also talked about that Tesla is orders of magnitude more complicated to run than Twitter, which is interesting given that
making cars.
He seems to be spending more of his time on Twitter these days, but he did talk about that. So it's kind of interesting here. You know, we'll see if he switches his attention going into the new year, but it feels like the shiny new toy is still getting most of his attention. And by the way, as we keep talking about, it has really cost Elon Musk and Twitter, and it has benefited one of the villains in the Musk universe, and that's people who have shorted Tesla shares.
Yes, some good commentary from our very own senior editor Miles Udland in the Morning Brief newsletter, looking at how much short sellers have cleaned up. But Julie, the stats on Tesla are not pretty. Down 70% from the highs last year. I believe down more than 30% in the past month alone. And you can make the argument this sell-off may just be getting started. And I mention that because the street largely has still supported Musk. But this was the week, really, where you start to see some of that Wall Street backlash, not just because of what he's doing in Twitter, but because the fundamentals of the business appear to be slowing.
And you see there the short interest in the stock, the data coming to us from S3 Partners, mark-to-market profits from those shorts, $15 billion this year. That doesn't reflect yesterday's decline. But, you know, obviously it's kind of incredible here. The next biggest short, by the way, the next most profitable short this year is Amazon. That's $6.2 billion. So less than half of what people have made by shorting Tesla this year. It has been a big profitable bet. There's one more thing that I do want to mention here this morning, because Elon Musk has really pushed this off and said, this is a macro problem, this is a Federal Reserve problem, they're raising rates, that makes my business more difficult. But to your point, there also have been some fundamental issues. One of the others is that the company remains, Tesla that is, not to be confused, the primary company, it remains under scrutiny by federal regulators at the National Highway Traffic Safety Administration. According to reporting from CNBC this morning, NHTSA now has included 2 more crashes in its broadening investigation of what it says are possible accidents tied to, or crashes tied to, Tesla's autopilot program. Doesn't seem to be having a big negative effect on the stock, but it is something that the bears have consistently pointed to as a potential negative for the company.
We can sit here for the next 2 hours and talk about this guy in Tesla. It's endless, and we're still going to be doing this again next year. It's just reality. But also we're going to be talking about tech stocks, because there's more happening in tech than Elon Musk. Tech stocks are headed for their worst month of December since 2002, headlined by some big losers. Tesla, Apple, and Alphabet all down over double digits during this month. For more on the tanking tech sector, let's go over to our markets master, Jared Blickery at the big board. Jared.
All right, time to talk about Tesla. Well, it's kind of
no.
All right, well, I'm going to weave that into the discussion here. Here's what happened yesterday. Let me just get a year-to-date view of what has gone on in the markets. Energy, the only sector that's up 52%, but the selling has been concentrated in communication services. Now that has Meta and some other of the mega caps that we know. Discretionary, consumer discretionary houses, Amazon. We're going to get to that in a second, and then real estate, and then tech. Those are the big underperformers here. Communication services down 40% almost. And then you take a look inside what's happened within the Nasdaq, and there's not a lot of green here. Now, Chinese stocks tend to be on their own when I'm doing this analysis. So when we're saying tech stocks, a lot of these Chinese names have already jumped up over the last couple of months. But you're seeing Meta down 65%, Amazon down 49%. This is its worst year for Amazon since the year 2000, when it was down 80%. So it could be worse. But let's take a look inside the EV sector as well. And this is where the Tesla analysis comes into play. When you're seeing on this heat map, this is a year-to-date performance, when the average stock is down more than 50%, you got to think that we're close to this bubble being washed out finally. And I just want to go to a historical analog. This is the mini S&P 500 futures. I'm going to put a 5-year chart. This is reminding me of 2018. So we were actually at the bottom. We didn't know it at the time. The bottom of a bear market. We had sold off almost 20% to the day. And then right after the Christmas holidays, we launched. And that Santa Claus effect, I'm going to be talking about that at 11 a.m. That starts today. The last 5 days of the year, the first 2 days of the new year. Guys, we have it now. If that opportunity is not seized, portends poorly for the new year.
Yeah, the Santa Claus rally doesn't seem to be getting off to a great start if futures today are any indication. But yes, that definition is important.
Yes.
That the period starts now. Everybody's been talking about the Santa Claus rally for all of December.
Well, it's here, and it's almost
over. It only
over.
just starts now, right. I do want to dig into one of those big tech stocks for just a second. If you can pull up Meta for me there, because we had some news this morning that Meta has agreed to now settle a class action lawsuit for $725 million, which says that the company gave third parties access to user data without user consent. That was on Facebook specifically that was regarding. And that has been, I mean, even among, this is something that our Dan Halley pointed out earlier in the week when he was looking at the worst performers of the year within tech. I mean, Meta is definitely a big one on that.
I mean, it's at the lows right now.
Oh, well, there's Amazon on there.
Oh, excuse me, Meta.
They're all ugly charts.
They're all at the lows, it
right
seems like.
Off of the lows here, but not too far off the lows.
Yeah, and 65% is that drop over the past year.
Yep.
Yeah, pretty bad. Pretty bad. All right, thanks so much, Jared. Appreciate it. Coming up, we're going to take another deep dive into the markets as investors digest this morning's inflation data and try to assess the Fed's path ahead. As we were just discussing, the Santa Claus rally not necessarily getting off to a good start. It's not rally yet. Stock futures down this morning. Investors are trying to move past yesterday's losses and hope for last-minute Santa Claus rally ahead of the holiday. Let's bring in Interactive Brokers chief strategist Steve Sosnick. Steve, thank you so much for being here. Awesome to see you here just ahead of the holiday. And as we look at the sort of lackluster action this week, I mean, can we extrapolate anything bigger out of it? Or is this, I mean, do we need to sort of discard the last few weeks of December typically?
Good morning, Julie. It's great to see you. And I think as much as a lot of us would like to just pretend the last couple of weeks didn't exist, we can't. And I do think that, some of the numbers that you guys were just discussing show you how the sentiment has really changed dramatically. And really, there's been people getting rid of their winners that had worked for them for so long. I mean, I know as you said, we could talk about Tesla the entire segment, but talk about the mentality change on that stock, and then you throw in Apple, you throw in Microsoft, Meta, some of these other stocks that had been big winners. This is in some ways 2000-ish. I know Jared drew the analogy to 2018, which there are many parallels to that as well. But this is more of a 2000-ish, where people got into these names, they fell in love with them, and now, for better or worse, they're falling out of love with them. And I think it's too big of a move to ignore. Some of it may be year-end window dressing, though, which definitely adds to the excitement, so to speak.
Steve, hard turn here. Buy, sell, or hold AMC?
You know where I stand on that one.
No, but really, it's wild. Some of these moves are insane, and they continue after that offering. I'm looking at the ape shares on the Yahoo Finance platform. They're going bonkers. AMC bonkers too. Just for the average investor out there, when they see news like this and these moves, what should they be doing, and what shouldn't they be doing?
Here's the problem right now with that. So yes, you actually should be seeing ape shares jumping and AMC shares falling as they converge to each other, because the new thought is that you're going to be able to that they're going to be recombined into one class. The ape shares were basically a vehicle for them to dilute the stock. The AMC shareholders said no, so they came up with an end around it. They have since diluted them. Now you have this deal where they sold it to someone for 66 cents, which isn't exactly it's raising money at that level. That doesn't tell you anything much good. And they're going to do a 10-for-1 split, which reverse splits never bode well. So I give Adam Aron credit. I'm not going to throw him under the bus here. He's trying his best to make the best of a difficult situation, and is using the status that he has with shareholders to raise money using equities. But he's shown a willingness to do it that way. So, ultimately, it's just sort of a constant battle against dilution. And I just want to thank you in advance for ruining my Twitter over the holiday weekend.
Happy holidays, Steve. Always good to see you, my man. Appreciate you.
Maybe it's a battle against dilution or delusion. I don't know which it is, Steve, because as you note in your note, there are still people out there who are buying the dip, which I thought was out of fashion. I thought that was very 2021. So I didn't know that investors were still doing that, but it sounds like on your platform they are. What do you think the thinking is, and is there any situation where that still makes sense?
Yes and no. I mean, what I was referring to in the buy the dips was what they're buying are sort of the Tesla is the number one most bought stock on our platform on a 5-day rolling basis. That can't be working out for people. And I guess the difference is buying the dip reflexively worked for the better part of 2020 and almost all of 2021. And when people find a strategy that works for you essentially 100% of the time, they're going to keep doing it. The problem is it's the kind of thing that doesn't keep working all the time. And when the facts change, your strategies need to change. And what you're seeing now is buying the dip reflexively is not a great strategy. Buying the dip overall is not a bad strategy. But you need, if you're buying a dip, you need to be considering, is this stock good fundamentally? And secondly, am I getting in the face of a freight train that's going in the opposite direction? So momentum matters. Again, 2020, 21, the momentum was generally higher. Almost every stock was trading up. The trend was higher. In so many cases now, the trend is lower. It's much more difficult to buy dips in a downtrend. that's where and I've said this on the program before, you need to think about buying dips and selling rips. But in general, I think the idea of buying growth stocks just because they're labeled growth stocks doesn't work anymore. I've been fairly consistent about this for the last couple of months, is I think that the artificial distinction between growth and value is gone. That doesn't mean that there aren't growth stocks, so-called growth stocks, that aren't also really good values. But if you're going to be trying to buy a dip, you better be doing it because you think it's a good value and because you think this is something I might have to hold for a little bit to realize that value, not necessarily for a quick trade, or not necessarily saying XYZ is down a certain percentage, therefore I'm going to buy it.
Well, Steve, one of those growth stocks that have been hammered is Tesla, like you just mentioned here. Are you seeing any signs from the charts you watch, the volume action you watch, that this stock is near a bottom?
Not yet. And I do have to disclose that I'm one of those people who has been short Tesla and long some put options, and it's been working out.
Holiday gifts on you?
Yeah, exactly. But so in a sense, not really, because the problem here is the rise that we're giving back was so dramatic. If you look back on the charts, we went parabolic. We started to go parabolic in 2020, late 2020, and then it got added to the S&P and, off to the moon, so to speak, or into orbit, to use the SpaceX analogy. But now, we're coming back, and it's not clear where the level is of support. And the bigger problem I have, and I think where you were talking before about analysts and changing their mindset, is I think Elon Musk has become much more toxic to a lot of the Tesla car buyers. I think that, to a certain extent, think of who was buying a Tesla and think of who he's now doing sort of alienating via Twitter. And those may be the same people. And that's really potentially very damaging to the brand. And we won't know this, but the idea for a while, that they're giving extra incentives into the end of the year tells me they must have some worries about meeting whatever their sales projections are. I don't think he's wrong necessarily to put some of the blame on the economy, but to a certain extent, Tesla buyers, they're not leasing them for the most part. These are more affluent buyers, and so yes, everybody's getting hurt a bit by the economy, but I think that I think that he's done some real damage to the brand through his comments. Maybe he just needs to be quiet and focus on the business for a while.
Steve, between your comments on AMC and disclosing you have been short Tesla, I think you're going to have a very busy weekend. My friend on Twitter, hey, it is what it is. Good to see you as always.
I regret saying yes to the producers.
No. We'll see you back next week. Interactive Brokers Chief Strategist Steve Sosnick. Always good to see you, my friend. Happy holidays.
Same to you, Brian. Same to you, Julie. Take care.
All right, straight ahead, we'll have the opening bell on Wall Street and look at a few hot tickers on Yahoo Finance. Do not go anywhere.
Welcome back. The opening on Wall Street just a few moments away, so we've got a few Yahoo Finance trending tickers to share with you. First up, avocados, my friends. I didn't even know this company was public and they existed until my good friend Brian Sazzi pointed it out today. Shares of Mission Produce slumping by 15% after numbers missed estimates in the latest quarter. Revenue was flat year over year as the rise in avocado volume sold was not enough to offset a plunge in prices. And I got to tell you, Brian Sazzi, I was very excited to talk about this today. We eat a lot of avocados in my house. I would say we can easily go through half a dozen avocados in a week. So
you just eat them? You scoop them out? Or are you just eating them?
Just put them with everything. Salad. Like my son had a half avocado with his dinner last night.
How have you been tracking prices though?
They've been going down. They have been slumping during the pandemic. Avocados got really expensive. You were paying like $3 or $4 for a single avocado.
You could have broke this news a month ago.
Now I've been quietly tracking it to myself. Now you can easily get an avocado for $1.50, right? Like they have really come back down.
I think we've reached peak avocado, Julie. I mean, you're looking at the explanation. You read the earnings release for this company. Bottom line is there's too many avocados in the market, and prices are starting to come down. Now, who this is good for? It's Chipotle. I remember a couple years ago when avocado prices went through the roof. This was pre-pandemic, and it really hammered Chipotle because obviously they buy a lot of avocados for their amazing guacamole that you have to pay extra for inside their business. So to see these prices coming down, I would not be shocked to hear Chipotle, when they report earnings in a couple months, really see a nice benefit from these plunging prices.
It would be nice if we could pay less for guacamole out of Chipotle, but they're not going to go in that direction.
They're not cutting the prices. We all know it's extra. If you want that, it is. And you know what? It should be extra because it's an amazing thing. It's amazing.
It should be extra, but should they be making that extra margin all to themselves? They will. Shareholders will like it, I'm sure. So interesting here. The Mission is saying the overall Mexican crop is expected to be 20% higher compared to the prior harvest season, but early season volumes are down because of the lack of pricing. So I guess there's just not as much motivation to grow as many avocados. Average avocado selling price down by 10% in the quarter. And as we showed earlier, 6% increase in avocado volume sold. One analyst at Stephens who covers the stock says there is a longer-term path to achieve margin recovery, but we can see it might take longer than originally expected. So just like we're seeing normalization in a bunch of markets, I guess the avocado market is seeing normalization as well.
I have 5 seconds left here, Julie. Do you pick the avocado out one by one, or do you buy the bag like we were showing in the photos?
Whenever I buy the bag, I regret buying the bag.
Me too.
Because
we don't know
inevitably you end up with one that is not great. So
right.
I do the single pick now. I definitely do. Are you a big avocado consumer?
I am. I buy them one by one. I think the avocados in the bag just are too small.
That is also true.
Yeah.
Yeah.
That's news you can use. All right, well, let's go from avocados to tech deals, maybe. Shares of Nutanix under pressure following a report that Hewlett-Packard Enterprise terminated acquisition talks. Talk of this deal really surfaced about a month ago and looks to be shot down. And it might just be for two reasons. One, HP CEO Antonio Neri, friend of the show, I think he's very focused on further developing his own darn business before he goes out and buys a company in Nutanix, and nothing against them. They've been struggling with a lot of executive turnover the past 2 years and also just slowing growth inside of their own business. So you put those two together, I'm not surprised to see the reports of this deal not going through. Yeah,
Nutanix shares, by the way, are down about 12% this year. They haven't fallen as much as some other companies because there has been this deal talk. So that's really helped support the shares. So now if we're taking away this deal talk, if it's not just HPE that's not a suitor, but others as well, then you could really see the stock start to come down more significantly.
And HPE does not need to make this deal, or really any large deal at this point. Sure, they have the balance sheet to do it, but they are seeing really strong growth in most areas of their business. Also, very strong backlog. And then additionally, despite everything that has happened in the economy this year, they've been able to push through price increases.
All right, and we're just a couple seconds away from the opening bell this morning.
I can't wait. There we go. There we have that opening bell on Wall Street. Charles Schwab, asset management, ringing that opening bell on the Friday before the Christmas holiday. See a lot of folks up on that stage cheering. Maybe, Julie, we'll get some big gains in today's session, but it does not look like that is going to be the case right now.
It does not look like it's going to be the case here right out of the gate. As we're watching stocks here this morning, it looks like we've got a lower open here. It doesn't make sense to show it like this. So let's show it like this.
Hey.
We're seeing about a 32-point decline on the Dow Jones Industrial Average as we get underway. The S&P down about 0.15%. The Nasdaq is down about 1/3% as things start to open up and settle in here into what we're seeing. And if we take it back on over to some of the heat maps that we are watching and take a look at the sector view here, we got a pretty even split. But again, it takes a little bit of time for things to populate. It looks at the moment like we are seeing energy stocks that are in the lead to the upside and continued weakness in tech. As we talked about earlier, it has just been a brutal week and month in technology. And by the way, when you look at the major averages, all of them except the Dow are down for the past 3 weeks of the month. So really it has been a negative September here that we've been watching. And just digging into tech a little bit more as we get underway here this morning, I'm seeing a decent amount of red on the screen, not quite as dark red as we saw yesterday. So there is selling pressure. It is not as acute as it was in yesterday's session here. But one more I want to just quickly look at is the travel stocks on everything that we are seeing with this winter weather. And right now, it doesn't look like we are seeing that much of a negative effect. We've got the likes of Delta that's trading up a little bit, Southwest a little changed. So we'll see if that changes or if investors maybe are already pricing it in, or maybe investors just expect things to be rocky during the holiday season. And so you don't get that kind of negative reaction. But Saz, we're going to talk to Helene Becker a little bit later on of Cowen to get a little more insight into what's going on with the airlines.
See, Avis, the rental car company, making a big move. Maybe our Brad Smith rented a car to drive to Ohio.
Maybe. I don't know if that would be any easier or better
I don't know.
in this situation.
All right, let's stay on the snow, though. Raymond James out with an upgrade on Toro. Shares in focus after the lawn care and outdoor products company was boosted from market perform to outperform. And Julie, this comes a couple days after a really strong quarter for Toro, notably in their professional segment where they sell zero-turn mowers, golf and grounds equipment, and other snow and ice management solutions, as Toro calls it. It's a very good quarter for them, also a good backlog. I really like the acquisition they made for about $400 in the summer of a company called Intimidator Group. And they sell riding mowers. And I went over to the site. They make Spartan zero-turn lawnmowers. And the one in the middle of the site looks like you can run over your neighbor's house with it. I mean, it's just that serious. I like it. I think it's a cool acquisition. Good for them.
Well, the company also was upgraded to outperform from market perform over at Raymond James. And that comes in the wake of those results. And the analyst there says that the company still has a big backlog of high margin orders in that pro segment that you talked about, and that is positive for it. And even with the recent gains in the stock, it's still essentially underwriting only low-digit sales growth in near perpetuity. So in other words, it's undervalued right now is what the analyst is trying to say. Even though the stock has done well, the price target over Ray J is set to $130 a share.
I'm just looking at the seat on the Spartan lawnmower, the zero turn. Almost looks like might be better than your Herman Miller chair, Julie. It looks that comfy.
It makes you wish you had a lawn, doesn't it?
I do. I kind of want a lawn. I mean, this thing's probably 10 grand.
But you really need a big lawn for a rider.
Can I just buy one of these and drive it down the street? I mean, they're really cool.
No.
No?
No, you cannot.
Okay.
All right, coming up next, a major price disparity between AMC shares and its APE units after AMC made some major announcements this week. We're going to break down the price action and what it means for AMC investors next. AMC shares continue to be up on the screen this morning after the movie theater operator announced a $110 million equity capital raise and said it was seeking a 1-for-10 reverse split of its common stock. Joining us now for an outlook on the company is Chad Bynum. He's Macquarie Group senior analyst. Chad, it's good to see you here. As I said when this release came out yesterday, the consensus seems to be, okay, this is a clever way to continue to inject liquidity into the company. But I tell you what, if you're courting retail investors and you put out this complicated transaction, I mean, I guess they love it no matter what. I don't know, Chad, what do you think?
Yeah, no, that's a good way to put it. I actually think this is kind of a step in the right direction for fundamental analysts, just because, this will help reduce some of the debt, reduce some of the deferred rent. Adam Aaron, he's probably one of the people working harder than anybody this holiday season. I don't think he takes many days off. And, they found a nice partner here. They found a cross-capital structure investor that owns some of the debt. They were willing to invest in the apes at a price already, well below where it's currently trading. And then those proceeds will, help reduce some of the debt, help reduce some of the deferred rent. They're not out of the woods at this point, but this is certainly a step in the right direction. And as you know, I'm sure there's, more announcements to come in the near term. There's some additional votes that could kind of help them free up some additional liquidity. But it was, a positive surprise for fundamental investors.
Chad, usually, or my old rule of thumb is anytime you see a 1-for-10 stock split or something like that, that is often the sign of a very distressed company. Do you view AMC as distressed, and do you anticipate some form of major restructuring next year?
Yeah, when we caught up with the company, the way that they framed it was, 5 years ago, they had roughly about 150 million shares outstanding. After all of these announcements here, they're close to 1.5 billion. So from a share count perspective, those will kind of put them back where they were, pre all of these acquisitions, pre the meme rally. So it's kind of getting back to that point. In terms of what it does, to your point, I don't really think, outside of a perception standpoint, it really matters that much unless they're able to, get additional approvals and raise equity at elevated levels. Maybe to your point, there's a little bit of a rally on the back of some meme investors not really understanding a 1-for-10 reverse stock split.
Are we even having this discussion next year about AMC being or just encountering a lot of challenges if the movie slate comes back and people go back to the movies and the movies are compelling and they're willing to spend more each time they visit?
I think the main issue is the number of releases. In 2022, we were back to about 65% of the quantity of releases that we saw pre-pandemic. Obviously, some big releases like Black Panther, like Avatar this past week, and like Top Gun earlier in the summer. But we still need a lot of the filler product. We're just not seeing that. 2023, what we're expecting is we'll kind of get back to about 80% of quantity, and then it's going to come down to quantity. I think some of the streamers have backed off a little bit. They're going to continue to try to add subscribers on their D2C products. But we just need more product out there. Frankly, these fourth quarter results, I think, are coming in a little bit below where most people had thought. Avatar launched fine. It's going to have legs, but what we saw in October and November, we're certainly a step back from what we saw earlier in the summer.
Yeah, Chad, if I can get a little anecdotal for a moment. My family, usually, being a Jewish family, we usually go to the movies on Christmas, right? And this year, my older son already saw Avatar. I don't know what else. There's nothing else that I want to see that's really out there. I already saw Wakanda Forever. It's going to be freezing. We'd rather just stay on our couch and watch stuff. And I imagine other people probably the same. So, when you don't have that robust slate that you're talking about, it seems like that's really going to be potentially problematic.
Yeah, I think good point. And, hopefully you can find something out there, some content that you and your family are interested in. I think the family product has been certainly below what we have seen in prior years. You have some releases like Babylon, like Whitney Houston's movie. Avatar is going to take up most of the screens. But if that's just not something that you want to do, sitting through a movie 3 hours and 10 minutes, and that's really the big knock against this movie, that it is a very long production. I don't think we have the wide array of products this holiday season, as you mentioned. And we'll start to see some of that in February and March. But certainly from a family-friendly standpoint, we're just not seeing the releases that we saw in 2018, 19, and even in 2020.
Well, Julie, I think AMC's airing the first 3 episodes of our show, all 6 hours from earlier this year. I'm really excited about it. I suggest you go and see that. Maybe you too.
I lived it.
Macquarie Group Senior Analyst Chad Bynum, always good to see you. Happy holidays. Appreciate it.
Happy holidays. Thanks.
All right, so much for $5 a gallon gas. The average price of gasoline has fallen to its lowest level since June 2021, as our friend Liz Ann Saunders points out over at Schwab. Gas prices aren't that far away from pre-pandemic peaks seen in 2018 and 2019. All right, coming up, Six Flags execs are feeling the heat because of their poor performance this year. More on this new activist situation next. After a year of poor execution and weak stock price, Six Flags execs find themselves under siege by activist investor Jonathan Litt. Joining us now for more on this battle is Citi leisure and entertainment analyst James Hardiman. James, good to see you here this morning. How do you think this one ultimately shakes out?
Yeah, I mean, I think the activist report that was put out the other day, it's certainly a good conversation starter, right? It gets people talking about what is ultimately a dislocation in the stock. But I think it's important to remember why we're here. We're here because this new strategy that was imparted by the CEO that came in roughly a year ago has thus far been extremely slow to bear fruit. As a matter of fact, the stock has moved in the wrong direction for the better part of the last year, which in this space, in this industry, with these assets that generate a lot of cash, whenever you have that sort of an underperformance, a dismal performance, you're going to get some level of activism, some level of sort of non-traditional alternatives to just running the business.
So in this case, the non-traditional alternative that's being proposed by Land and Buildings is to sell the real estate or spin it off and put it in a real estate investment trust and then lease it back Does that make sense to you, a move like that?
It makes sense. It's certainly not a new idea, right?
Right.
This is an idea that the company evaluated pretty seriously back in 2016 and 2017 and ultimately decided against. There are a lot of aspects to this, right? I do think some of the valuation metrics that were used by the activists were maybe a little bit optimistic. There are very much tax consequences of any move like this. But I think the longer the stock sits here in the low 20s, and at one point it was in the high teens, the more that you can make an argument for this sort of financial engineering, right? This valuation arbitrage at the end of the day. Does this happen in the format that's been proposed? My guess is not, but there are a lot of steps in between, right? They don't have to take their entire real estate portfolio and sell it in one piece. The idea that they could take a property or two or three and use that as a source of capital and ultimately lease that back, that seems like a more likely course of action here.
And of course, I should mention, we reached out to head of comms or head of communications over at Six Flags, Stephen Pertell. He just hasn't felt like getting back to us. I do want to ask you this, James. What gets people back in these parks? What is the fundamental problem with Six Flags? Does the food stink? Are the rides boring? How do they regain or jumpstart their business?
Sure. So there's two components. The industry, right? And we did see some slowing really over the course of the summer across the industry. And I think that's just sort of macro pressure. I do think the theme parks generally hold in better than most sort of discretionary forms of entertainment. But then there is the company specific aspect of this, right? Six Flags put in this strategy, we called it the Jerry Maguire strategy. Fewer customers, better service. A lot of people, basically said that they fired their customer this year. And so the idiosyncratic part of the story has kind of been a mess as of late. I think there's still a chance that this strategy may work, but they're going to have to figure out how to win back at least a portion of those customers that they didn't want to lose.
And James, while we have you here, as we are in this holiday season and there's been so much talk about people moving around, traveling, you cover the cruise line operators as well. And at this time when people want to still be getting out there, how are you viewing the cruise industry and sort of where it is in that period of recovery?
A lot of risk still, but also a lot of opportunity. Look, so much of consumer discretionary right now is figuring out the recession impact on these various categories. The good news, if you want to call it that, is a recession, if it's just a recession, would be an improvement for the cruise industry relative to where they've been the last couple of years. We're finally starting to see some better pricing, right? We've seen pricing up in just about every category. Carnival just announced the other day that their pricing is now up versus 2019. I think there's an opportunity here, and I do think this has historically been a remarkably resilient industry. That said, there's a ton of risk, right? There is weather risk, there is COVID and other sort of viral or disease-related risk. There's the war is a big deal, right? The war in Ukraine certainly is problematic as you think about people moving around to different parts of the world. Obviously, fuel costs, right? That is their biggest single expense line. So there are a lot of moving parts to the story. If we could fast forward to 2 years from now, 3 years from now, I think the whole cruise industry is going to be in a much better place. But it might be we might be taking the scenic route, just given how many external factors can move these stocks.
Excellent wordplay. Thanks so much, James, and happy holidays to you. Thanks for spending some time with us today and this year as well. Citi Leisure and Entertainment analyst James Hardiman, thank you. Well, coming up, it was a strong year for private equity firms despite a tough economic backdrop. What can we expect from them in 2023? We'll have a breakdown on the other side. Private equity deal value reached $819 billion in the first 3 quarters of this year. That's higher than any previous annual amount on record, save for 2021. Can the good times in private equity continue into next year? Brian Sossy's got a take on that.
Yeah, sure. Take over. No, Julie.
Why not?
Okay, so we got some new data out from S&P Global saying that the amount of dry powder, or the other way of saying it, cash that private equity firms have, now approaching $2 trillion. That is absolutely huge. Some further stats here to break this all down. Nearly 1/4 of the industry's estimated cash reserves was held by just 25 firms. Of those top 25 firms, 18 were based in the U.S. and 7 in Europe. The top firm with the most dry powder or cash to put to work, Blackstone, almost $44 billion, the largest cash hoarder out of all the private equity players. With nearly $34 billion in cash reserves, Thoma Bravo, which has been making power moves, I would say, the past 6 months, recently buying Coupa Software in a headline-grabbing transaction a couple weeks ago. They're on that list as well. In number 2 and number 3, Advent International Corp with about $32.5 billion in dry powder or cash to go out there and make some deals. And here are some of the biggest deals we have seen this year. Of course, we've seen Coupa make its acquisition. You've seen Blackstone with the American campus, and Thoma Bravo doing its thing over there with Coupa, and then, of course, Citrix earlier in the year. Some really big deals, and you get the sense, Julie, that they might be able to continue next year as you get rates starting to peak out just a little bit. But the bottom line is this is a lot of cash for these companies to be having at a time where valuations, especially in software like a Coupa, they've been absolutely hammered. Well,
and it helps them to have this cash so they don't have to borrow money to do LBOs, right? Although there have been some LBOs. In fact, there was a big one earlier in the year. But the corporations that lent them the money to do the deals now are having trouble selling that debt on the other side. So it seems like cash deal, the deals this year will likely, at least initially, be driven by that cash.
Right on. Hit me with the take. Not surprised here, I guess. The feast. The feast is coming for private equity. And there I'm holding a feast of cash. $2 trillion in cash is a lot. And again, with these valuations where there are a lot of good businesses out there really trading at valuations that are not only attractive versus the broader market, the S&P, Nasdaq, you name it, but also versus their historical averages. And as you get a sense that rate increases have started to peak out, maybe by the middle of next year, you can see probably see PE make some headline-grabbing deals.
Interesting. Look forward to that.
Look forward to reporting with you, Julie.
Yes.
Yes.
Coming up, Americans are bracing for that winter storm and severe cold weather across the country. We're going to get the latest from AccuWeather's John Porter on the other side of the break. Stay with us.
Love this guy. Welcome back to Yahoo Finance. I'm Brian Tazzi alongside Julie Hyman. Brad Smith has the day off. We're awaiting some numbers on consumer confidence. Julie, really markets right now, you're seeing losses accelerate to the downside. Dow down more than 177 points.
Yeah, and as we await this economic data, a reminder that we got personal incomes coming in for the month of November a little bit hotter than expected, up 0.4%, but spending was more anemic. Personal spending in November up just 0.1%, half of what was expected. So that's the sort of backdrop for markets today on what is a low volume session ahead of the long holiday weekend. We're getting those confidence numbers now. 59.7 is the reading for the University of Michigan December final number. So we've gotten some reads before, but 59.7, again, relatively high here. Current conditions, though, a little bit lower at 59.4, expectations at 59.9. We got the conference board numbers earlier in the week that came in a little better than estimated. That was a little bit surprising. And as we talked to economists this week, it sounded like it's because inflation is moderating a little bit. Maybe that's something that's feeding into this more positive.
Look at this reversal in the markets, Julie. Coming on, we were down 177 points just seconds ago on the Dow. That number hit. Dow now down only 55 points.
Yeah, we also, by the way, just got new home sales. New home sales better than estimated, interestingly, at an annual pace of 640,000. That is up 5.8% month over month. Economists were looking for a decline there.
Yeah, a little nugget here, market liking good news, maybe rewarding it a little bit. Nothing wrong with that.
Nothing wrong with that. All right, let's talk about something else that's affecting many, many Americans right now, what travelers are facing the days ahead. Weather, not so jolly heading into the holiday weekend. For more on the ramifications, we bring in now AccuWeather's lead and chief meteorologist, Jonathan Porter. John, it's good to see you again as we try to make sense of this winter weather that is coming here to the Northeast, that has already hit much of the U.S. I was looking at FlightAware earlier, and man, those delays and cancellations are really stacking up.
Boy, Julie, good morning. They really are stacking up. As we spoke about yesterday, and AccuWeather's been warning for days in advance, the risk of widespread and cascading, far-reaching flight delays and cancellations, more than 10,000 flight delays and cancellations yesterday. And we talked about that because big hubs were affected, Chicago, Detroit, and of course, along the I-95 corridor. It wasn't the snow, it was the heavy rain and the gusty winds. Those winds have been a big problem overnight. We're dealing with hundreds of thousands of power outages now being reported into the AccuWeather newsroom here this morning. And that number is going to continue to mount. The broadness of this wind field is a big story. And Julie, I'm afraid that the flight and other travel cancellations are going to continue to be a major issue today as this rapid freeze up heads eastbound toward New York and the I-95 corridor.
Jonathan, what is in store for the East Coast?
Well, what we're dealing with right now, as you can see on the latest radar, is there's a little bit of rain across the New York City area and back in eastern Pennsylvania. But you see those blues, that's an area where across Pennsylvania where the cold air is surging in. And so temperatures in, for example, New York City were up near 60 overnight. They're going to be falling to 24 by 5 p.m. this afternoon. So that frigid air is on the way, and that's going to lead to a rapid freeze up. And what we're talking about with that is that the issue is that the roads are going to look like they're wet, but as soon as that cold air comes in and it comes rushing in, everything is going to start to freeze. So roadways and sidewalks, they might look just wet, but they're going to be a sheet of ice. We've already seen that with traffic accidents across Ohio and Pennsylvania, and that's what's heading eastbound toward the I-95 corridor. So be aware of that as we head through the day.
Jonathan, I'm curious. You mentioned that you guys have been warning about this, and it does seem like we had a decent amount of advance notice for this storm, for the winter weather. Is that typical for this time of year? Is it that the technology is getting better? Can you give us a little bit of behind the scenes here?
Yeah, I think it's a couple of things. I think obviously the accuracy and technology continues to get better and better. And we certainly are on the leading edge of that here at AccuWeather for both businesses and consumers all over the world. But I also think it's also the communication. It's how we have a expertise with that in terms of how we message the weather impacts so that it can be most helpful for people to enhance their safety, their family's safety, and also for businesses to take the right actions. And so it's not only just having the right forecast, but it's also understanding the impacts to your business and having the right plan to take action. No longer can you just say, well, weather's just going to happen to me. You as a business leader, you have to be prepared and ready to take action. The forecasts and the insights are there. Now we'll see how businesses and governments take action with that here in terms of dealing with a very serious situation across the country that's going to lead right into the holiday weekend.
Considering how bad this storm has been, Jonathan, what is the broader read for how the winter will shake out?
Well, that's a great point. And actually, we've been talking about parts of December being quite chilly here for months in advance. But it looks like it's actually going to slowly moderate here as we head into January. So maybe a little bit more in the mild weather as we head into the central and eastern part of the country into the first part of January, but then probably getting back to winter here before too long, heading into February. So that's the general look. And as we mentioned yesterday, this chill, although it is really intense, especially in the southern part of the country, will start to moderate by the time that we get to Christmas Day and beyond, which is good news. But look at the AccuWeather real field temperatures tomorrow morning. This is just downright frigid temperatures. AccuWeather real field temperatures in Atlanta, for example, well below zero. This is some dangerous cold. We've also been monitoring the Texas power grid, where so far the grid has held up, but the real test is going to be tonight when some of that wind backs off and the temperatures remain very cold. ERCOT believes that they're going to have enough power to meet the increased demand, but that's obviously something that we're going to have to monitor very closely.
All right, well, stay warm out there. AccuWeather lead and chief meteorologist Jonathan Porter. Good to see you again. Appreciate it.
Stay safe. Happy holidays.
Thanks, you too. All right, another story on the road we're looking at is Tesla, as Elon Musk says he will not sell any more Tesla stock for another 2 years. This comes after Musk sold $3.6 billion in stock last week, bringing his total sold over the last year to nearly $40 billion. Joining us now to discuss the path ahead for Tesla is George Giannarakis, Canaccord Genuity Managing Director. Good to see you here this morning. Now, you have more of a positive stance on Tesla than I think the market is thinking about right now. You say there are green shoots over the next 6 to 12 months. Take us through them.
Sure. So the market doesn't seem to be very positive on Tesla currently, and it's understandable. I mean, we listened to a conversation that Elon Musk had yesterday on Twitter Spaces, and it sounds, decidedly negative in terms of the near term. There's a lot of uncertainty around Q4 deliveries. There's a lot of uncertainty around 2023 deliveries. There's a lot of uncertainty around the margin trajectory of the firm and whether or not they decide to cut prices to spur volumes. But when we look over the next 6 to 12 months and over the next multiple years, whether the depth of the recession is actually pretty positive for Tesla. It puts a lot of the competitors on the back foot. They have an incredibly strong balance sheet to weather it. And out the other side, they're sustained to increase their leadership in EVs, which we think are on the cusp of really accelerating the penetration of the overall auto market. So look, the near term is incredibly uncertain. It's being reflected in the stock, but sometimes stocks tend to bottom before the fundamentals do. So when we look out over the long term, there's a lot of long-term earnings power here. The company has lots of growth vectors, whether it's EVs, semis, robotics, and we are very, very positive in the long term of the firm.
George, does Elon Musk need to find somebody else to run this thing?
Tesla or Twitter? Which one?
Both at this point.
Both. Look, I've been covering the stock for a long time, and we've been through a lot with Mr. Musk. Give us a lot of controversial data, whether it's smoking marijuana on the Joe Rogan podcast, allegations of fraud. Most of these things have been proven to be false. And without his leadership, I don't think Tesla, I have a very high degree of conviction that Tesla wouldn't be here. And with regards to Twitter, we'll wait and see. He's already pledged that he'll step down as CEO and run the software group there. But I am a big fan of his, and I hope that he stays on Tesla for as long as he can.
You also call Tesla a sustainability behemoth. Walk us through that.
Yeah, I mean, look, it's the largest. I'm a sustainability analyst here at Canaccord Genuity, and this is the largest company in our universe. They've done more to push the world towards a sustainable energy future than any company I cover and any other company in the world. They have both leverage to generation through their solar business, through electric transport, obviously through their EVs, and through energy storage with the batteries that they put on the grid. They do a lot of things, and they cover almost every vector of the sustainability universe. So if someone's looking to invest in improving the world and moving and hopefully improving climate change, this is the number one vehicle through which you can do that. And there's a lot of earnings power. There's good cash flow long term. There's good cash flow currently. We'll wait to see what 2023 brings. So this is for us, it's the way. It's the most liquid. It's the largest cap way to invest in improving the world and moving away from climate change.
Are there any other plays, though, George, that are, where Tesla was 5 years ago? In terms, maybe not in terms of potential scope, but like Tesla, we all know about, right? What's the next thing that is going to be that sustainability leader?
So we cover several stocks in the universe, in the sustainability universe broadly. We like a lot of them, whether it's a company called Fluence that participates specifically in energy storage, which is putting batteries on the grid. Big fans of their long-term trajectory and near-term trajectory. Frankly, we call it their fundamentals anti-fragile, meaning that as the supply of batteries loosens, which have been very tight over the last 12 to 24 months, it actually helps them quite a bit because they're in the business of putting batteries on the grid. So their demand should remain pretty robust, given that there's a lot of positive implications from the Inflation Reduction Act. But the supply of batteries loosening actually helps the trajectory of the firm in terms of their profitability. We also like small companies like Wallbox, which make chargers for EVs, small cap, but a very good product and big growth over the next several years. To other companies like Ameresco, which is a local company here in Boston, where I'm from, and they participate in several of the sustainable technologies out there, whether it's solar, renewable natural gas, energy storage, which we just talked about. It's sort of a way to invest in the broader sustainability landscape, as opposed to just whether it's EVs or just battery storage.
Interesting insight here. George Giannakis, Canaccord Genuity Managing Director. Good to see you. Happy holidays.
Thank you. Same to you guys. Thanks for having me on.
All right, analyst notes on FedEx continue to trickle in following earnings results from the logistics giant earlier this week. This one by Evercore ISI. Jonathan Chappell caught our attention, especially as FedEx touted $1 billion in new cost cuts. Says the analyst, we contemplate a slower volume recovery and a material slowing of yield expansion that offsets much of the new cost targets put up there by FedEx. All right, coming up, getting down to business. FTX founder Sam Bankman-Fried released on a mega bond, while in the media world, Bloomberg reportedly looking to a huge acquisition. Julie has today's top headlines next.
Let's get down to business now with a look at some of the other headlines we're watching in business and beyond. After 18 months, the House January 6th committee has released the full text of its report into the deadly attacks on the U.S. Capitol. In over 8 chapters and 800 pages, it asserts the panel's belief that former President Donald Trump was himself responsible for the attacks and outlines the scope of his campaign to overturn an election that he said was stolen. The publication of the full text comes after the panel recommended the Department of Justice pursue criminal charges against Trump. Sam Bankman-Fried has been released on a $250 million bond as the former FTX founder awaits trial on a host of criminal charges. The bail amount, one of the biggest in U.S. history, it's been secured against his family's assets, which include a home in Palo Alto, California. His release means he'll stay under house arrest at his parents' residence and surrenders his passport. SBF, as he's known, did not admit or deny guilt at that hearing. And Target has recalled over 200,000 weighted blankets after reports that 2 young girls died after crawling inside the items. According to the U.S. Consumer Product Safety Commission, the 2 children, aged 4 and 6, died from asphyxiation inside the pillow fort blankets. The agency is urging users to return the blankets and ask for a full refund. And finally, possibly a big shakeup in the media world. Axios reporting that Mike Bloomberg is interested in acquiring the Wall Street Journal parent company Dow Jones or potentially the Washington Post. The reporting suggests the billionaire wants to expand his media empire and that Dow Jones would be potentially the ideal fit. Really interesting here as we look at this. It seems very preliminary, Saz, these discussions and Mike Bloomberg's desire to look at these companies, but obviously it would make for a big change in the business and finance media world.
Right, Julie, nothing in this report from Axios suggests the deal is going to happen tomorrow or the day after, maybe even in the first quarter, but this would just continue the consolidation in this media industry, and the consolidation, by and large, has been driven by Dow Jones, going out there, buying an IBD. Of course, they own Barron's. They're a longtime holder of MarketWatch here, but this would be a major, major deal. And of course, marry the likes of a Wall Street Journal with the amazing data platform that is the Bloomberg terminal. Well,
at the same time as we have seen some deal making being done by that empire. Of course, we have the division of News Corp and Fox, right? Now trading separately. There's been talk about maybe them coming back together. And the Axios report says that perhaps would give an opportunity for a spin-off of Dow Jones of some kind. Again, this is very preliminary. Axios makes it clear that Mike Bloomberg knows Rupert Murdoch, who, of course, is controlling interest in News Corp, but that hasn't even brought it up to him yet. So this is like...
But the other side is the Washington Post. They also mention,
yes.
This is another report I've seen over the past 2 or 3 weeks start to emerge that Jeff Bezos, Amazon founder, may want to sell the Washington Post.
Maybe. I mean, let me be clear as well. You know, I am a former employee of Bloomberg, worked there for many years. And almost as long back as I can remember, there was discussion about some other kind of tie-up with Bloomberg and another company. And nothing of that kind of magnitude ever materialized. There are some smaller acquisitions that the company has done. So take it with a grain of salt.
To be determined.
Yes.
All right, Micron added to the general sense of economic doom and gloom with a disappointing earnings report this week, weighing on the likes of rivals like NVIDIA and AMD. What about the sector itself? KPMG has released its latest outlook for the industry, and the report says that for the first time in its 18-year history, it sees autos as the most important driver of revenue, surpassing $250 billion by 2040. Joining us to discuss is Mark Gibson, KPMG's Global and U.S. Head of Technology, Media, and Telecom. Good to see you here this morning. What is the outlook? I could appreciate the outlook longer term 2040 is very bullish, but just take us through the outlook for next year. What might that look like, especially if we get a recession?
Yeah, thanks for having me on. You know, it's very clear to us that automotive is in the fast lane for the semiconductor sector. The sector's been through a lot in the last few years. And the executives that responded to our survey remain very bullish about where this sector's going. There is huge demand for these little tiny chips that drive so much of the innovation and the economy in our world right now. And I think the automotive sector was really no surprise to us. We've been talking about it for a number of years as it's emerged as the leading revenue driver for 2023 for the semiconductor sector. And you think about these new cars that have really become just computers on wheels, and over 1,000 semiconductors in an average new car these days. So interesting reports coming out of this, and I think the sector remains really positive going into 2023.
At the same time, if you're relying on the car business for growth in 2023, I don't know how the prospects of that are looking in terms of auto sales, right? In terms of going into a potential recession, it's hard to see that auto demand is going to be blockbuster in 2023.
Yeah, I certainly think it's helped with the chip shortage that we've been talking about for the last couple of years. As the demand softened a bit, it's given the semi industry a chance to catch up a bit. There's also tremendous opportunities across a lot of other electronics. You think about the wireless industry, which has been the #1 revenue driver for semis for many, many years in our surveys. Many of us hoping to get the new smartphone or the watch under our tree this year. So it's certainly beyond just the auto industry. But when you think about where cars are going, the conversion from the combustible engine to the computing machine that they've become today, I think it is a really, really positive place for semis to be looking as they go, not just into the next year, but certainly into the decades ahead.
Within your forecast, Mark, how big a role do driverless cars play in it?
Yeah, they play a role. I mean, you think about a couple of things there, where those cars are going. The driverless cars will probably double or more the number of chips that they take to run as well. So it's not just the EV trend that we see, it's the autonomous trend. And it's also for the big tech companies a chance to get into this sector. You think about not just the car manufacturers, but the sensors and the cameras and the battery innovation that's required to get into this sector, both EVs, autonomous vehicles, and the like. So lots of opportunities, all of them heavily reliant on the semiconductor industry.
While the automotive group might be the source of growth for many of these semiconductor companies, it's still not the biggest, right, by far. It's still just a sort of a small and growing area for most of them. So when you look at the bread and butter, you mentioned, of course, mobile phones. You've got PC growth that has been sort of waning. I mean, where do you see where we are in the inventory cycle overall, given that most of the commentary over the past 3 months from the chip makers has been there's a glut and it's not going to be worked down anytime in the very near term?
Yeah, it's really interesting to see how that supply chain and the chip shortage, where are we with the shortage or a surplus, how that's evolved in our survey over the last couple of years. As I said before, a couple of years ago, it was all about the chip shortage. Now we have almost 2/3 of the executives in the semiconductor industry that responded to us saying they think in 2023, that shortage will have basically worked its way through and have gone away. It's obviously dependent on the types of chips we're talking about. There is a lot of demand as this world goes more and more digital. We have more and more things reliant on the semiconductors. So agree with you. It's not all about the auto. It's not all about the electronics today. But I do think we've stabilized a bit, and I think that's a really positive thing for the sector.
All right, we'll leave it there. Mark Gibson, KPMG's Global and U.S. Head of Technology, Media, and Telecom. Good to see you. Happy holidays.
Happy holidays to you. Thanks for having me on.
All right, when we return, Yahoo Finance and Nez Foray will have a look at the oil markets headed into next year. We'll be right back.
It's been a roller coaster ride for oil prices this year in the wake of Russia's invasion of Ukraine. Is this volatility set to bleed into next year? Yahoo Finance's Inez Frey is here with a look ahead. Hi, Inez.
Hi, Julie. Hard to believe that earlier this year we saw oil at just above $130 a barrel. Right now we're looking at WTI around $80 and Brent crude at $83. But where will these oil prices be next year? Well, I asked several analysts, and let's put up a board so you can see some of the projections for 2023. You've got Ed Morse from Citi projecting that Brent crude will average around $80 per barrel, with WTI averaging $75 a barrel. JP Morgan says that Brent will average around $90 a barrel next year. And then you've got OPES over at Dow Jones that are saying that Brent is going to be anywhere between $95 and $96, with WTI at around $90. Now, several factors are assuming this, though, that supply grows with projects in Norway, in Brazil, Argentina, Mexico, US, Canada. Also, the successful reopening of China, and also Western nations able to avoid a severe recession, because there are many projections of a recession. But if that recession is severe, then of course that would impact demand, guys.
Inez, you're also tracking some supply news from Russia.
Yeah, that's right. Well, Russia now threatening to cut production of around anywhere between 500 and 700,000 barrels a day. And that's why you're seeing crude oil today jumping quite a bit. WTI up 3%, part of the reason. Brent crude up 3%. And that's in response to the G7 price cap of those $60 per barrel. And something interesting, though, some data from Bloomberg that was looking at tanker data in the first week that this measure took in effect, as well as the EU maritime ban of Russian imports. That first week, you had imports, total volumes shipped out of Russia down 54%. Now, that's only 1 week, so you can't really go by 1 week's data, and there are some other factors that are involved here as well. But if this trend continues, then those measures may not be having the intended consequences that you'd want, because what the consequences are of those measures is that Russia doesn't have as much money to fund the war.
Ms. Frey, thanks so much. Appreciate it. All right, holiday travelers are taking flight, with our next guest calling this the penultimate week of the year for the travel industry. But this winter storm is threatening to upend that holiday cheer. Cowen senior research analyst Helene Becker joins us now. Helene, always nice to see you. Happy holidays to you. So we're seeing a lot of these delays. Things are really getting worse today, but we're not seeing a lot of we're not seeing a lot of movement in these airline stocks. Why is that the case?
Yeah, I think they're already down so much year to date, and especially this quarter. I think there's not a lot of further downside risk from these levels, and the storm, the weather is the weather. They're doing their best, I suppose. I mean, not to be apologetic for them, but there's only so much they can do when storms like this roll in.
I mean, they also had a pretty good advance notice for this one, right? It's not sudden. It's been going on for days. The forecasters told us way in advance it was happening. And so they seem to have gotten ahead of it, offered people the opportunity to change ahead of time. And that seems to have helped things as well, right?
Yes. I mean, they do that, especially with winter weather, right? We've talked in the past about summer weather, how you have these pop-up thunderstorms and there's not a lot you can do and they create delays. The winter weather, you generally, to your point, get a lot of warning. We've seen the storm roll in. So the airlines have they've asked people, if your plans are flexible, rethink them. And they try really hard to give you advance warning that your flight will be either delayed or canceled, so that you don't go to the airport and sit around for 8 or 10 hours. The problem occurs, I think, when you have a flight from one city to a hub, and that flight goes on time or is only a few minutes delayed, and then you get to the hub only to find out your connecting flight has been canceled. That's where I think the worst of it winds up.
Helene, is there one airline that is best equipped to weather storm activity like this?
I don't know that answer specifically. The way I think about it is the airlines that deal with the weather all the time. So think United and American in Chicago, Sun Country in Minneapolis, Delta in Minneapolis, Detroit, Salt Lake, Alaska Air in Seattle, United in Denver as well. I think those airlines and more to the point, those airports handle that weather a lot better because they're used to it. It's when you get cold weather or an ice storm somewhere in the south, like Atlanta or Dallas, or even Houston, they're not as used to dealing with that kind of weather. So maybe things get more snarled up there than they do further north.
Helene, I want to broaden it out and talk about what's going to happen next year. I have to say, I've been a little bit surprised in some of the numbers you were sharing about how many travelers are going through right now, that it's actually a little bit below last year, right? And I'm just wondering, for all of the hype that we are hearing about everybody wanting to get out and travel right now, how sustainable that's going to be next year and how profitable, that's key, of course, the airlines are going to be.
Yeah, those are really good questions. So here's how we're thinking about it. The days don't match up, which is why on some days you see fewer travelers than you saw last year, just because of the way Christmas fell last year, Saturday this year, Sunday, and in 2019 it was a Wednesday. So you had fewer days to travel than you do either this year or last. So that's one thing to think about. For 2023, we're thinking that domestic leisure won't grow as much, probably flatten out a little bit. We do think that we're going to see some recovery in business travel and international, especially in Asia, as some of those Asian countries continue to open up. Not so much China, because they're still dealing with COVID and trying to figure that out. But the time change, right, between the U.S. East Coast, let's say, and Japan or Australia, Korea, those are big business markets, the West Coast in those markets. When you think about a 6 to 12 or 15-hour time change, it's really hard to do Zoom calls. So I think you're going to see some increase in business travel. Right now, we're down 20% year over 3. Next year, we think we'll be, we're not going to do year over 4. We're going to talk about travel versus this year, and we think we'll be up 5 or 10 percentage points from this year. So still down versus those days before the pandemic, but up. And we think that recovery will continue. We also think international will grow. Right now, we're actually flat to up international outbound. International inbound is down, and that's, I think, because of the strong dollar. But we think we'll see an increase next year in international, and we think we'll see a continued shift in mix from the absolute back of the plane, the basic economy, the really low fares, to people buying up to more leg room, paid load factor. People don't realize this part, but paid load factor in the first class or business class cabin has gone from under 50% to more than 70% right now. So that shift in mix has positive implications for profitability, which is really why we're so upbeat on the group, even in the face of a potential consumer recession. And I would just point out the stock prices are back to 2020 lows. So they're already, the stocks themselves are already saying things are bad. And yet revenues are above 2019, 2020, which not too hard for that, but 2018 levels.
Real quick, Helene, FedEx warning of delivery delays for holiday packages. Yeah. How much does that disrupt this quarter for them?
Yeah, this is the first month, of their quarter. So not sure it's that impactful for them these couple of days. And they will do their best, as will UPS. And I'm sure Amazon is in that category too. Those are your 3 big delivery companies, right? If you've bought things, I think they'll all try to get them there as much as possible by tomorrow night. And if not, by Christmas morning, to the extent weather allows. They don't want to play the Grinch, for sure.
No, they definitely do not. And finally, Helene, just very quickly, I was really enjoying your book recommendations and what your book groups have been up to at the end of your note. Really quickly, favorite book of 2022?
Oh, that's so hard, but I have to tell you, tomorrow, I loved that book. And there's a funny story I have about that book in me, which I can't share because it's too much of a spoiler alert. But if you read the book and then then next time you and I chat, I can tell you what happened. But I loved that book. And I also love anything by Taylor Jenkins Reid. So I liked Carrie Soto is Back. I thought that was a fun read, and it came out right around the U.S. Open, right when Serena was having her run. So I thought the juxtaposition of the two was great. So thanks very much. I'm always happy to hear that people people are reading, not even the books I read, because interspersed with some of those is a lot of trash. But,
yeah.
But
well, you gotta keep yourself entertained.
Yeah, exactly. And I just think reading is wonderful. It's very mind opening. Is that an expression?
It is,
anyway.
It is an expression, and it's the correct one in this case. Helene Becker, thank you so much,
Thank
both
you.
for the airline analysis and the book recommendations. Always good to catch up with you. Happy holidays, Helene.
Thanks. Same to you guys.
Thanks. Coming up, with the 2022 nearly behind us, the healthcare industry is preparing for an innovative and momentous 2023. We will bring you predictions on the other side of the break. Many in the U.S. are grappling with a mental health crisis, rising costs for care, and now the triple-demic. But as the year comes to a close, what's the outlook for these and other healthcare trends for 2023? For that, let's get to Columbia University healthcare policy professor and private equity investor Megan Fitzgerald. And also joining us for the conversation is our healthcare reporter, Anjali Kamlani. Meg, it's always great to see you. Oh my gosh, I love the holiday red that you're wearing today. And you also surveyed some executives within the healthcare industry to try and figure out what's going to be happening next year. And sadly, some of the trends are the same as they were this year, including still labor shortages, which is really interesting to me given what we're seeing writ large in the labor market.
Yeah, correct. I mean, what I learned in the survey is healthcare is traditionally a defensive sector, not tied to the ups and downs of the economy, as you guys report on, a bear market and a pending recession. So it tends to hold up better than others. It doesn't mean it all goes up, but it often declines less. And when I talk to industry insiders, they are still grappling with labor. Either labor exiting the workforce early, retiring, frontline workers being burnt out. In fact, a recent poll showed about 66% of hospitals stated that they either had to delay care or alter care because they did not have staff on the front line to deliver care. So everyone I spoke to, 25% of the survey respondents put labor shortages number one, Julie. It's not going away.
Meg, Anjali here. I wonder, with all of this, how much do you think technology, not just telepresence, but just other apps and the like, that we've seen a push for, do you see the reality of that coming through in 2023 with, higher utilization?
Yeah, so everyone stated that the extension of the telehealth benefits have now really made telehealth telepresent. It's not going away. Everyone is using it. It's lowered cost. It's increased quality. Consumers like it. They were forced to use it during the pandemic, and now they've come to find out they like it. So it doesn't replace, an in-person visit for something that is really acute, like an MI or, even needing surgery, of course, but it does help to triage patients and allow them to see a provider when maybe they would have had to wait a few weeks, especially with the shortage. So this definitely is a positive on the other side of that negative trend.
Meg, one of the things we saw a little bit of in 2022 was some consolidation in the industry, particularly primary care practices being sort of rolled up. Is that a trend that's going to continue? And what does that mean both on the business side and on the patient side?
Yeah, consolidation was the number 2 trend after labor shortages. And the reason why is, Julie, if you think about the titans of the industry, there are only 5 payers who make up 50% of the market. There's 3 distributors that make up 95% of the market. And there's a handful of pharmacies that make up 50% of the market. So where are they going to go to grow? They're likely going to start looking at all of the assets that were overvalued, and people paid a high price for them last year during a really epic year of M&A. So I think there's going to be an opportunity for some of the titans of the industry to go shopping. And I think a likely place to look is going to be digital health, primary care assets, and pharma services.
I wonder about that, Meg. When you're talking about these titans and where they have to move, there's been so much discussion about the vertical integration and what the results have been, the impact on the healthcare economy. On one side, there's still a discussion about trying to reduce costs of care. And to your point, telehealth and digital presence has helped with that. But then you combine that with the labor shortage, and it seems like there's a bit of a flux situation on what exactly this healthcare economy is going to look like in 2023. So aside from those, specifics, what do you see the whole picture looking like?
I think it's going to be pretty positive because I think people tend to flock to healthcare when there is a dislocation or there is a downturn. And I think what we saw this week, and you have done really great reporting on that, is the enormous stimulus bill that was passed this week. A lot of money was allocated towards access, cost, and quality. The dedication not to hurt physicians right now and kind of not hit them too hard with Medicare cuts, I think is showing that we also have a bit of a backstop from the government to say healthcare is really important. It took some people the pandemic to realize how important it was, but I think healthcare looks pretty good for next year. I think I'm going to lean in a little bit to say I'm somewhat bullish on my own industry. I usually always am, but I think more so now than ever.
And Meg, just real quickly here, you just mentioned the pandemic, but it's not anywhere in those trends in healthcare, right? COVID, pandemic not mentioned. Are there any sort of reverberations of the pandemic that are really informing any of these trends?
Yeah, it's interesting. I thought for sure, especially given the flu season, no one wanted to put the pandemic. Maybe they didn't want to, Julie. Maybe they're just tired and they didn't want to say it. But the pandemic kind of bleeds through all of this, right? The questions you both are asking me, whether it's shortages, the move to digital health, alternative sites of care are really growing. We're doing more acute procedures outside the hospital. So any assets that have, looked to have surgery centers, urgent care centers, all of that is growing. So maybe you don't pick the pandemic as a trend, but I think the pandemic has forever changed healthcare, and it certainly is considered in everything that we do and every M&A transaction that people partake in. I think the pandemic has forever left them differently and made them, different deal makers. It's forever going to change the landscape of healthcare. It's hard to ignore that.
Yeah, that makes sense, certainly. Megan Fitzgerald, always good to catch up with you. Happy holidays. Thank you for being here. Columbia University Healthcare and Policy Professor Megan Fitzgerald, and she's a private equity investor too. And our Anjali Khemlani. Thank you, Meg. And Anjali is sticking with us because we have to talk about the latest in China as well. We were just talking about, with Meg, all of the potential trends here in the U.S. But obviously, China, when it comes to the pandemic, is where we were kind of at the very beginning.
Yeah, that's a fair assessment. And also in terms of their strategy, how they're continuing to roll back on the zero COVID policy and really reducing testing, asymptomatic case reporting and the like. So we're not getting the full picture, kind of like what we're dealing here in the US. But as of right now, there's some really concerning estimates out there. China alone saying that in the first 20 days of the month, they could have had close to 250 million cases, or 18% of the population being impacted. Meanwhile, we've seen estimates that they could be seeing up to 1 million cases per day and close to 5,000 deaths per day, and with estimates reaching to really 4 million cases by March. And that's really a strong number. We've never seen these numbers for China to date because they haven't necessarily been reporting them to the like. And it really goes back to the discrepancy between what these numbers say and what the projections say, and then what the visuals are. We've been seeing, those disturbing images of body bags piling up, ambulances outside funeral homes and the like, and hospital wards filling up anecdotally. All of this also leading to a shortage in the number of medications that are available. So, reports of feeding into the black market as well when it comes to medication access to help curb or help treat some of the symptoms of COVID. So really a concerning picture for China right now when it comes to COVID surge.
Definitely concerning. Thanks for breaking down, Anjali Kamani. Appreciate it. All right, the year is coming to a close, but not before some big news in the media industry. Yahoo Finance's Ali Canal has more on this next. Rising costs, debt-ridden balance sheets, and a renewed focus on profitability weighed on the embattled media sector as investors quickly punished companies struggling to turn a profit. Yahoo Finance's Alexandra Canal joins us now with the breakdown.
Thanks, Saz. It's been a wild ride for media companies this year. Netflix down 50%. Disney and Paramount Global, same story there, down roughly 45%. But that's nothing compared to Roku, which has dropped 80% on the year, with Warner Brothers Discovery and Spotify sinking more than 60%. In this year alone, the stock market wiped a whopping $500 billion plus off of the market caps of major media giants, with more pain expected in 2023. So how do we get here and what could happen next? Let's start at the very beginning. 2022, post-COVID, post-stay-at-home trade, and we saw subscriber growth levels slow. Netflix lost users 2 quarters in a row during the first half of the year, while NBC's Peacock saw 0 growth at all in the second quarter. So amid that slowdown, coupled with those declines seen in linear television and a shaky macro environment, investors shifted focus to profitability. Are you a business that can make money? As a result, we saw mass amounts of layoffs, hiring freezes, massive restructuring efforts. And remember, these companies were spending tens of billions of dollars a year on just content alone. So it was a huge transition. But despite it all, there were some bright spots in 2022. Number one being ad-supported. Netflix and Disney rolled out their respective ad tiers towards the end of this year. A lot of optimism on the street when it comes to how advertising can help add incremental revenue and help hedge against churn, especially as competition intensifies. So that's something to look out for in 2023. Another highlight was that studios regained confidence in the box office. We had some record-breaking movies this year. Top Gun Maverick smashing a 15-year-old record, by far the top movie of the year. And then those Marvel films like Wakanda Forever, Doctor Strange also killed it, easily nabbing 100 million plus openers. And even though Avatar 2 did miss expectations, industry executives still say the film will outperform and continue to add box office dollars throughout the holiday season and into 2023. So theatrical, not fully back to those pre-pandemic levels, but not as pessimistic as things seem to be in 2021. And then finally, another thing to watch will be more media mergers and acquisitions. As profitability is pressured, M&A is often the go-to solution. There's lots of talk on the street that Paramount could be unloaded. Disney, what will Bob Iger do with ESPN and Hulu? And what about WBD? Could that be a potential acquisition target down the line? So there will be assets for sale. It's a direct result of this soul-searching moment for the industry. In 2023, it's going to be a year of tough decisions. And I think it's safe to say not every media company is going to survive that.
Well, I guess we'll see what that means for this coming year. That was Yahoo Finance's Alec now breaking down the year in media. We'll be watching to see what 2023, of course, holds for the industry. Coming up, President Biden penned an op-ed for Yahoo News on the state of the U.S. economy. We'll discuss that on the other side.
President Biden is showing optimism around getting inflation back down to normal levels, which he laid out in an op-ed he penned for Yahoo News. President emphasizes the importance of controlling inflation and warns there still may be setbacks along the way. And to me, very lengthy op-ed over at our sister publication, Yahoo News. But the takeaway here, he still thinks there's a potential setback in inflation. I think most investors would agree with him, and that's why you're still seeing a lot of stocks in this market under pressure, notably those tech stocks that are very tied to what the Federal Reserve may or may not do next year. At the same time, he also emphasizes what he's been doing on the manufacturing front. And in technology, of course, we've seen the last few months notable for the groundbreaking of some different semiconductor making facilities in the U.S., trying to bring that industry back to the U.S. Now, will it be successful? It certainly won't be a short-term thing at all, but it should be interesting to see how that plays out. And what I haven't really heard from a lot of strategists, maybe we do avert a recession. Maybe it's just slow growth next year because, as the op-ed points out, job creation is still happening in this country. If gas prices down, inflation is starting to come under control, but of course, to be determined. Yeah, most strategists think there's going to be a recession. I know. This has been the most talked about recession that I've ever really covered. It has. Let's take a look at markets here before we leave you, because we are seeing a mixed picture now. Look, the Dow and the S&P 500 have now perked up. The Nasdaq is now lower. Of course, when you look at the action in these waning days of 2022, you can, of course, assume that volume is relatively low. That means swings are more likely to happen. Mm-hmm. So that's something to keep in mind here. But, we'll see if the Santa Claus rally ends up happening. I just keep watching AMC shares. That is my stock to watch going into the long weekend. Right now down 9%. It was over 40% before. It's wild. I mean, talk about your swings. This is going to be a very long session for that stock. Yeah, that's definitely one to watch. All right, that's going to do it for us for today. Akiko Fujita and Rochelle Akufo have you for the next hour. Have a great holiday weekend, everyone.
Welcome to Yahoo Finance Live. It is 8 a.m. on the West Coast and 11 a.m. on the East. I'm Akiko Fujita, along with Rochelle Akufo. Here's what we're watching at this hour. Holding patterns. Stocks tread water as investors digest cooler inflation data and rising consumer confidence. Tech shares head to their worst December since the dot-com bubble burst. The big question, where is the Santa rally? Not asleep at the wheel. Elon Musk says he has not dropped the ball on Tesla and says he won't sell any more shares in the EV giant for 2 years. Our panel looks to the coming year for the billionaire and a stock that is down 70% on the year. And the storm strikes. Thousands of flights canceled, major highways closed, and power outages rising across the U.S. as the busiest travel season of the year gets slammed by a monster weather event. We speak with AAA at this hour. But first, let's take a look at major indices. We saw a bit of a split picture here with the Nasdaq. Those tech names continuing to get hurt here, although down just about 36 points or 40 points right now. The Dow up 7 points. We're trading pretty flat there, as is the S&P 500. The S&P 500, by the way, looking to try and avoid that 3 straight week of declines. But right now we are seeing it just teetering into red territory there. In terms of sectors we're watching today, energy, the biggest gainer on the day so far. And as we look at Treasury yields right now, we are seeing them all up. The 5-year yield at 3.84%, the 10-year at 3.7%, and the 30-year yield at 3.8%. Rochelle.
And as you mentioned, there are millions of Americans hit with a winter storm as the country braces for the Arctic freeze. And while temperatures drop, the cost of home heating is expected to rise by 17.2% from last winter. That's according to the National Energy Assistance Directors Association. I mean, this is something that a lot of people have been panicking about. I mean, when you look at versus the previous winter, you're looking at bills at about $1,200 this year for the winter, and then 36% higher than what we saw in the 2020 to 2021 blast. And as we're mentioning, they're bracing for this storm, really pushing up crude oil prices. They're up more than 3% on the day, rallying here. Only really the silver lining here we saw from Gas Buddy, from Patrick DeHaan, saying that at least when it comes to gas prices, you're looking at those bottoming at about $2.99 a gallon on this rally at the moment.
Yeah, I mean, those are the impacts we're looking at broadly. We're likely to see in the medium term, but in the most immediate term, Rochelle, you know, there's a lot of travelers out there that are getting very nervous about whether they're going to make it home or wherever they're headed for Christmas. 6,000 flights canceled, more than 20,000 delayed, at least through today. And there are implications here for the holiday beyond just travel. We heard from FedEx as well as UPS warning that packages scheduled for delivery today and Saturday may not arrive until after Christmas. That's going to disrupt a lot of plans that are out there, Rochelle.
Absolutely. I mean, and when you look at some of the temperatures that we're potentially looking at here, minus 45 degrees when you factor in wind chill, and that's affecting a lot of these power grids. We're seeing outages, particularly on the East Coast. We're seeing Texas under pressure as well. We know that Texas's ERCOT grid is still underestimating demand, so they're also having some problems there as well. But as you can see, predominantly we're seeing most of that on the East Coast. So a lot of outages there at the worst possible time, and, you know, heading into the holiday week, really a tough time.
Yeah, I think that's when I'm allowed to just sort of flex that in LA we're expecting temperatures of 70 degrees, but we'll keep that one pretty quiet. Let's talk about what we're seeing out in the markets right now. As we said at the top of the show, we did get some economic data, and this is personal consumption in PCE, personal consumption in expenditure, personal spending, up 5.5% year on year in November. So that's a bit of a cool down from the 6.1% we saw in October. Now, the key here is the Fed's preferred gauge, which is core PCE. That actually came in stronger than expected. So we're talking about a 4.7% increase year on year. 4.6% is what was expected, and that's probably why we're seeing the kind of reaction we said today, although, you know, December 23rd, not always the heaviest trading day. We should point out some improvements here in terms of what we got from the University of Michigan, the Consumer Sentiment Index. That did rise slightly, and Rochelle, this probably speaks to some of the economic data that we've been seeing that points to, well, core PCE, at least today, was stronger than expected. Overall, the trend has been moderating in terms of price increases. University of Michigan saying specifically, sentiment remains in relatively downbeat at 15% below a year ago, but consumers' increasingly negative attitudes have softened this month on the basis of easing pressures from inflation. Is it enough for the Fed to slow and sort of crawl back their rate increases? Not necessarily, but that's at least a good sign if you're thinking about where things have been headed. Or have we finally reached the peak? And certainly a lot of economists have argued we have.
And that's the question. Every time this data comes out, we wonder, what is going to be that tipping point? What is enough data for the Fed? Obviously, they're looking at backwards-looking data, and you don't want the medicine to be taking hold and you go too far. The Fed doesn't seem to be worried about going too far. I know that they said it's worse, in fact, to take their foot off the gas preemptively and then make it worse and then be back in the same position again. But with every little bit of data, you get a bit more encouragement. But the Fed, at least at this point, still staying relatively hawkish.
Yeah, they've always said it's not just one data set, it's not just 1 month. They have to look at all things sort of combined. So we'll continue to monitor that. Let's talk about another story we're tracking this morning, and that is Elon Musk back in the spotlight. Did he ever leave the spotlight? As the Tesla CEO takes to Twitter Spaces to say he will not be selling any more shares. This also coming as Musk looks for his replacement as Twitter's CEO. So what does this all mean for the future of Tesla and Musk? Here to discuss is Tom Forte, D.A. Davidson Managing Director and Senior Research Analyst, along with Craig Irwin, Roth Capital Partners Senior Research Analyst. Craig, I'm going to start with you here because, there's a lot of investors out there for Tesla who are saying, I think I've heard this one before. It was back in April when Elon Musk said he's not going to sell any more shares of Tesla, and he in fact did. So what do you make of what we have heard from Elon Musk this time around, and does that alleviate some concerns you think Tesla investors have?
Yeah, with his aggressive involvement at Twitter, I think there's concern out there, particularly given that there's knowledge he's looking for another $1 billion in cash to fund operations at Twitter. When people saw him at the World Cup hanging out with Jared Kushner, it's nice to see him making good friends, but the suspicion is that he's there to meet with a certain investment authority. And that means that if he gets turned down, there could have been more stock sales at Tesla. So people have been concerned about that. I don't follow Twitter, but I follow what's going on there very closely for Tesla. And it's much more aggressively managed than people think. I understand that the headcount is now below 1,900 people versus I think the last number I heard was around 2,400. So needs cash. But cares about Tesla a lot. It cares about Tesla's stock price a lot, probably more than he should, and really needs to focus on where he wants to spend his time and how he wants to spend it.
And Craig, I know that a big part of what happened with Twitter is this loss of ad spend, this loss of ad dollars. And according to Pathmatics, a research firm, they said about 70% of Twitter's top 100 ad spenders pre-Musk weren't spending around December 18th during this time frame. So a real pullback there. What is Musk going to have to do to instill confidence so that people don't think he's going to end up selling more shares of Tesla to prop up Twitter?
See, it's a circular problem, right? So Tesla's valuation we've seen is egregiously overvalued in the market. My price target's 85. I do rate it neutral, but Tesla has had a valuation based on hype, a multiple of the rest of the entire automotive sector combined. You look at Twitter, though. Twitter is a machine. It is a machine for putting out messages to large amounts of people very quickly, and a lot of the information is not verified or checked. So it's interesting that Tesla's valuation based on hype, and then Twitter being a hype machine, and Musk obviously sees tremendous economic value over at Twitter, just like he does obviously at Tesla. I mean, Tesla's pioneered EVs into the modern era. But it's kind of a circular problem, because as he spent more time at Twitter, people are saying that Tesla's being ignored. And, he's a talented executive. Everybody wants him to focus on where they're invested rather than in something else.
Tom, while there are questions about Tesla, that naturally brings up, what's next for Twitter. As Elon Musk says, he's listened, he's heard what users on Twitter have had to say in terms of him exiting as CEO. What do you see as that next step for this company as it tries to at least steady the waters, the choppiness that has been brought on by Elon Musk's presence there?
Sure. So the way I think about it is Elon always anticipated that his time spent at Twitter as CEO would be short-lived. I think when he put the poll out on whether or not he should remain CEO. He had an expectation that that would be the outcome. So what Elon's doing for Twitter is trying to get it on track for the long term, and then on a near-term basis, try to adjust both headcount and culture. But ultimately what Twitter needs is, it has tremendous influence, but historically it is well under monetized that. So if you look at the average revenue per user for Twitter, materially lower than Meta platforms. And that really calls for an executive whose specialty is digital advertising, and that's not Elon. So I think what you're going to see here is that he acquired Twitter. He's done a good job of adjusting, I don't know if moral compass is the appropriate term, but making some adjustments to the culture at Twitter. The next step is bringing in someone to materially improve digital advertising. And that's going to be a challenge given the current state of the advertising market right now, from what you're seeing at Snapchat, Meta platforms, really across the board. So multiple challenges there.
And Tom, in terms of credibility, obviously broken promises about selling shares and then, not selling shares and then turning around and flipping and then saying perhaps, Twitter will help benefit Tesla investors in the long term is what he tweeted without really breaking it down. Now, we know that with all this sort of very public display this circus, we've seen some price target cuts here. Dan Ives at Wedbush cutting his 12-month price target to 175 from 250. So still seeing some upswing there, but this really is still lingering. How much deeper do you think this can get before things turn around for Tesla?
So the way that I think about it is Elon has tremendous intellectual bandwidth. So if you're investing in one of Elon's companies, be it Tesla, Twitter, SpaceX, the Boring Company, you don't expect to have 100% of Elon's attention. But less than 100% of Elon's attention is much better than 100% from many others. So in my opinion, I would imagine that he'll continue to sell shares of Tesla as he tries to get Twitter on firmer footing. And we'll see how it plays out. But I think that's going to be what we'll see over the next 12 months, despite what he tweeted on potentially having a 2-year window without selling shares.
Finally, Craig, so much of this has been discussed in the context of Twitter being the overhang on Tesla, but there are, of course, other factors within the auto sector, the EV sector. Tesla facing a lot more competition here. There's questions around demand on the back of what has been, recently announced price cuts. What do you make of that picture, and how aggressively do you think competitors can move come 2023 to take away market share from Tesla?
It's been inevitable. It's one of the key pieces of my bear thesis for the last couple of years is that the share erosion would accelerate and other people would be growing faster than Tesla, and that's really playing out. There are very many successful brands coming into the market, great cars. A lot of the SPAC IPOs have had a problematic ramp, but then there's some very large, well-established OEMs like Ford and Porsche that have compelling vehicles. So, that's a given. But just to go back, if I can, to Twitter, the most important catalyst probably for Tesla in the next month is if we do see someone like Dick Costolo come back as CEO, right? Jack's back in the seat. All those advertisers that dropped out would probably be back in a snap, and everybody would say, okay, phew, we can get back to Tesla. Elon's going to be focused on growth over there. The longer term catalyst for this year will have to be things that materially move the needle at Tesla. I think the semi is a joke. I think they really need to get back on track with the mini car and getting the India facility built, bite the bullet, and then you'll see a real turnaround in sentiment because people will see the organic long-term growth opportunity. And that's what gets people excited about Tesla.
Indeed, it always has. A big thank you there to Tom Forte, D.A. Davidson Managing Director and Senior Research Analyst, along with Craig Irwin, Roth Capital Partners Senior Research Analyst. A big thank you to you both and have a great weekend. All right, let's turn now to the broader markets. As the year-end approaches, investors look ahead to the prospects of a Santa Claus rally. But will investors end the year with a holiday gift or a big lump of coal? Well, with more on this, we have Yahoo Finance's Jared Blickery. So, Jared, what are we expecting?
That's right. The official Santa Claus rally kicks off today. This is the fifth last day of the year. It's going to continue through next week and the first 2 trading days of the new year. That's 2023. As you can see, it's a mixed day here. The Dow is up, the Nasdaq down, S&P 500 just up marginally. And I want to show you what's going on a longer term basis with the Nasdaq. You can see down 33% year to date, and we are camped out by the lows here. This is reminding me of the end of the year in 2018, and we had a bear market at the time. Fed was in focus, and there was a little bit of a change of mood. In fact, the S&P 500 the day after Christmas had its best day since 2009. And interesting news there, and I'm not going to get into that, but I just want to show you what's happening with the S&P 500, because the Santa Claus indicator was actually invented by Yale Hirsch back in the 1970s, and this is an indicator that's really trying to tell you what is going to be happening in the future more than reflecting what's happening at the end of the year. So let me just show you. This is a December seasonality pattern. This is the Dow, S&P 500, and Nasdaq. Lots of lines here, but the bottom line is that it tends to trough in the middle of the month, and here's where we are, tends to accelerate into the end of the month. And so if we can take advantage of that, we do have some good prospects for January, and that's kind of where all of this fits into place here. Yale Hirsch, as I said, invented and named the Santa Claus rally back in 1972. It's misunderstood. It's not a trading strategy. It's an indicator. The SCR is a short, sweet rally that runs from the 5 trading days of the new year to the first 2 trading days of the new year. S&P 500 posts an average gain of 1.3%, and here's where it gets really critical. Failure to rally, that is, if there's a failure of the Santa Claus rally, it tends to precede bear markets, or times when stocks could be purchased at lower prices later in the year. And here's the famous line from Yale Hirsch: if Santa Claus should fail to call, bears may come to Broad and Wall. That would be Broad Street and Wall Street down at the New York Stock Exchange. So it combined with what happens in January could portend either strength or weakness in the new year here. So we'll have to see, and we'll revisit this in the first 2 days of January, guys.
Yeah, love the festive red jacket, Jared.
Thank you. Appreciate that.
Let's hope that's a sign of things to come. At least investors hoping for that Santa Claus rally. So. Thanks so much for that. Well, coming up, thousands of flights canceled, major highways closed, and power outages rising across the U.S. as the busiest travel season of the year gets slammed with a winter weather storm. We're going to speak with the AAA about all of the disruptions we are seeing out there after the break.
A massive winter storm is putting a damper on holiday travel, with airlines alone scrapping thousands of flights since Wednesday. And for the 100 million Americans traveling by air, that is unwelcome news. Well, joining us now to discuss the weather's impact on travel trends is AAA Northeast Senior Manager Robert Sinclair Jr. Robert, thank you for joining us. A really tough break here for travelers. You know, a lot of people are perhaps saving all their travel plans for this incredibly busy time. What sort of weight are we expecting on the roads this year?
Boy, it's going to be very busy. 90% of the 112 million people that will be traveling will drive to their destinations. And with the winter weather throwing a wrench into the mix, we think it's going to be very bad. We were anticipating 898,000 breakdowns nationwide over the holiday travel period anyway. When you throw the weather into it, it just makes the situation worse. And the cold weather in particular is very bad because it makes batteries lose power and it makes tires lose pressure. And flat tires and dead batteries are the top items we get calls for. So we're anticipating it's going to be rough, at least for the first couple days. The fact that the holiday is so long helps out.
You know, so many people already on the roads right now. What are you hearing in terms of road conditions as we see this winter weather or winter storm take hold across the country?
Well, many parts of the country out in the Midwest have closed the roads. They've shut the roads down completely because of blowing and drifting snow. And that's a problem. Visibility is a problem when people can't see, they crash, and lots of bad things happen. So road closures lead to people being stranded by the side of the road. Hopefully they've got sustenance to keep them going, some water and some non-perishable foodstuffs. Certainly we make it a priority of those who might be stuck out on the roads, especially if they need pulling back onto the roads. People slide off. That's something we call an extrication at AAA, when they slide off the road and we have to winch them back on. We see a lot of those kinds of calls during this type of weather. So all across the country, it seems that we're getting this kind of weather. And particularly for those parts of the country that are getting deep freezes and aren't accustomed to driving on icy, slick roads, it can be very dangerous indeed.
And especially with gas prices, falling at the moment, a lot of people perhaps encouraged to hit the road versus flying. But what about in terms of air travel there? What sort of disruptions are we seeing and how prolonged might that be?
Oh, flights are getting canceled and delayed all across the country. And very interestingly, New York is kind of the epicenter for a lot of air traffic control delays. Roughly 70% of all the air traffic control delays ripple from the New York area. We've got 6 major airports here. And because we're still using antiquated radar, ground-based radar, air traffic control, when the weather's bad, the planes have to get spaced out from maybe 2 or 3 miles apart to 25 to 50 miles apart. And that stretches things out and causes delays. We're in the process of switching over to GPS-based traffic control, I should say. Most countries around the world have done it, but we're geographically vast. And it takes more time for us to switch over to these new systems. It's called next generation. And so we're seeing lots of cancellations and delays. It might be a day or two to recover, depending on how bad it is in your particular part of the country, because if your flight is canceled or delayed, it's probably because there's no plane, and the plane has to get to where you are and turn around and be able to take you to where you want to go. So it's a bad situation. The timing couldn't have been worse.
Okay, well, wishing safe travels for everybody who is out there, whether it's in the air or out on the road. It's going to be a very busy next few days. AAA's Robert Sinclair Jr., always good to have you on the show. Appreciate you joining us today. Merry Christmas to you.
All the best to you and ours. Thanks very much for having me.
Well, key part of a closely watched inflation gauge showed price growth eased less than expected in November, while consumer spending missed estimates. The PCE index rose 0.2% in November from a month earlier, suggesting the Fed's interest rate hikes are helping with inflation, which is, of course, welcome news to the Biden administration. Yahoo Finance's Jen Schonberger spoke with White House economist Jared Bernstein on the state of the economy and more. Jen, are they starting to see some of those price pressures ease and maybe potentially want to tout that a bit more?
Good morning, Akiko. Ahead of that latest inflation data, I sat down with President Biden's chief economist, Jared Bernstein, at the White House on Thursday and got the administration's view on why the peak in inflation may be behind us and why the White House believes a recession could be avoided next year. Bernstein told me he feels good about the slowdown in inflation, pointing to the 2-point percentage drop in headline inflation on the consumer price index from about 9% in June to 7% as of November. Bernstein telling me, quote, "I hope that the peak in inflation is behind us," but added the caveat, I'm pretty cautious about calling any kind of global peak. We've seen head fakes before. That said, there are reasons why we're confident that we've seen some positive momentum. He said it's possible the drop in prices could stick because of the slowdown in core goods inflation, thanks to better functioning supply chains and goods getting to shelves faster. Now, when it comes to the outlook for the economy, Bernstein told me, quote, a recession is not inevitable. He says recent data support the economy transitioning to growth below last year's levels, but still positive while job growth slows, basically outlining the so-called soft landing scenario talked about so much by the Federal Reserve and Wall Street. Now, Bernstein suggested to me that the Fed's forecast for economic growth is consistent with the models he sees for below average GDP growth. Now, the Fed forecasting growth of just 0.5 percentage point next year before ticking higher to 1.6% in 2024. Akiko?
Priorities then when it comes to economic development going forward?
Hi, Rochelle. Bernstein told me that President Biden's biggest economic priorities for next year will actually be implementing the 3 key major economic legislative packages that have been passed under his administration, notably the Infrastructure Act, the Inflation Reduction Act, and the CHIPS Act.
Okay, Jen Schomburger, thanks so much for bringing us that conversation. Of course, you can read all about it on our site as well with Jen's story there. A programming note, by the way, later this hour, we're going to be joined by former FDIC Chair Sheila Bair on why the Fed and Jerome Powell should hit the pause button on rate hikes. That's coming up in a few minutes right here. You certainly don't want to miss that. Well, coming up, bail granted. Sam Bankman-Fried is released on a $250 million bond, one of the biggest bail amounts in U.S. history. How did this happen and what are the next steps? We've got a legal expert. Yes, our very own Alexis Keenan to break it all down for us on the other side. Reactions across social media soured on the decision of a Manhattan federal judge after the judge granted bail to FTX founder Sam Bankman-Fried. Bankman-Fried was released from custody yesterday after appearing in a U.S. court for the first time on charges accusing him of defrauding FTX customers and investors. So why did the judge agree to free Bankman-Fried from custody? That's bringing Yahoo Finance legal reporter Alexis Keenan. Alexis, this is a case that the U.S. attorney over in the Southern District of New York claimed was the biggest financial fraud in American history, or one of the biggest. $250 million is nothing to sneeze at, but a lot of people are surprised.
Yeah, a lot of people upset with the judge across social media, as you said. So this right to bail, though, it's really governed by the Constitution's 8th Amendment, particularly. Now, it's not an absolute right, but it does prohibit what's called excessive bail. And that flows from the fact that in the U.S., a criminal defendant is presumed innocent until they're proven guilty in a court of law. So there are two central questions, two justifications, actually, that a judge is going to look at. And there's two that in particular allow a judge to detain a defendant. And one is to keep the public safe. If they're a threat to the community's safety, the judge can say, you got to stay behind bars. Second is to ensure that the defendant will actually show up in court to face the charges against him or her. So in Bankman-Fried's case, like in most white collar cases, the judge said, well, Bankman-Fried is not a danger to the community, despite those that argue otherwise, perhaps financial risks, they say. So this case really, for the judge yesterday, it turned on flight risk. And to combat flight, the judge can impose financial and other types of consequences. So that's one reason why you saw the judge agree to the prosecutor's request of that whopping $250 million bond. Now, typically, a defendant needs to pledge enough assets that equal about 10% of that bond amount. So here in this case, it would be $25 million. Bankman-Fried's bond is secured in part by his family's, his parents' $4 million Palo Alto home. He also needs to get these signatures between 2 and 4. I'm not quite clear. I haven't got a clear answer whether it's 2 people or 4 people, but they have to be folks that have, quote, considerable means. They've got to be wealthy people to help substantiate the fact that they're going to make sure and attest to the fact and put their financial assets at risk to make sure he shows up in court. So that is how that works. The judge also set some additional conditions, home detention. Bankman-Fried has to wear a monitor, electric monitor. He has limited means to go about Northern California as well as a few places in New York. Also, he had to surrender his passport. And he also cannot make financial transactions that exceed $1,000 without some additional authority. Akiko?
All right, I'll pick it up from here. I mean, being monitored at home when you're in a $4 million home, not too shabby, much better than, I guess, the Bahamian prison. A big thank you to Alexis Keenan there. All right, coming up, former FDIC Chair Sheila Bair on why the Fed and Jerome Powell should hit the pause button on rate hikes. That's coming up. Finding the soft landing. Today's inflation and consumer confidence data is adding to the debate over whether the Federal Reserve should take its foot off the gas. Now, the market's still second-guessing Chair Jay Powell and if he's determined to hike the economy into a steep downturn. Now, our next guest has added her voice to the debate in a Yahoo op-ed that she says the Fed should hit the pause button and reassess. Sheila Bair is the former chair of the FDIC and currently serves as a senior fellow to the Center for Financial Stability. Good to see you here. So give us your argument as to why you think the Fed should take its foot off the gas right now.
Right. Well, I think they should hit pause. I'm not saying they shouldn't continue to tighten, but I think they need to take a breather to assess the impact so far of the actions they've taken. You know, to their credit, Jay Powell has been heroic. The Fed has been heroic. They frequently point to Paul Volcker, a personal hero of mine as well. But there are some key differences between then and now. For one, we've had this very protracted, 14 years of near zero rates. There's been a lot of buildup of leverage in the system. We didn't have that problem during the Volcker years. The rate of increase also is much more profound. You know, they've taken rates from near zero to over 4.25% in just 1 year. That's like a 6,000% increase. Volcker did, significant rate hikes. They were more long annual hikes of 50%. And then finally, the tool they're using, I think, is arguably much, much more powerful than the traditional tools that were available during the Volcker era. Now they essentially pay banks and other financial intermediaries not to lend. So they give them a nice, safe place to put their own money, their reserve accounts, or something called a reverse repo. They can get a nice return on that just by letting their cash sit idle. But that really has a powerful incentive to constrain credit in a way that I don't think we fully understand. This is a new tool they've never used before for this kind of a significant tightening. So yes, all of those uncertainties and differences, I think you've been heroic, good for you. Hit pause, take a breather, see the impact this is having on the economy before you go forward. And then you'll have a better sense of how fast you should be going forward.
Yeah, Sheila, it's interesting to read the op-ed that you wrote, sort of doing the point by point that you just laid out right now. But I wonder if we pull back here and we look at the rate of increase. You said 6,000% is kind of what we're looking at right now. Do you think those moves have been justified?
I think they had to act very quickly. I mean, I think everybody, there's no sense finger pointing, but they were late raising, right? They didn't do it until early this year. So even though we saw inflation was getting to be a problem in 2021. So they were a bit late. They needed to catch up. And so I understand why they went very aggressive. But I do think there's a question now whether they went too far, too fast. I don't really want to second guess. I think they were late. Given the fact they did need to play catch up, I don't want to second guess what they've done so far. But I do think now it would be good to hit pause. Another aspect of this where they could try a different approach is focus more on shrinking their portfolio versus just raising short-term rates, the so-called Fed fund rates, which is what they do with this, basically paying intermediaries not to lend. That's a very powerful tool. If they could hit pause on that, but maybe accelerate shrinking the portfolio, especially mortgage-backed securities, that's hardly rolled off at all because the rate of refinancings has slowed so much with interest rates going up. So they might think about selling some securities as an alternative approach. That would be more targeted on the housing market. I know the housing market's under distress too, but the good news is most homeowners are protected. They've got fixed rate mortgages, they've got equity in their homes. I know it's painful for realtors, for mortgage originators, but if you want to have a targeted focus on inflation drivers, and housing's a huge inflation driver, they perhaps through portfolio shrinkage, MBS shrinkage, could do a little more targeted on mortgages and again, take a pause on the short-term interest rate increases, which really has much more dramatic recession risk and labor market risk. One other thing, there's so much focus on Larry Summers and a lot of the other inflation hawks on this, and I count myself as an inflation hawk, maybe not as hawkish as he is, but they're so fixated, and Powell is as well, on the labor market. We had more been to declining wage growth for over a decade after the great financial crisis. Labor markets, wages need to catch up a bit. And hourly wages actually are still, they're not going up on a real basis. So to suggest this is a huge driver and that this is something we have to focus on, which really means if you want to target that, you're going to take the economy into recession. I don't think that's the right way to look at that. Focus on other areas where I think there's more bandwidth to tackle inflation without hurting the broader economy. But the labor force, they had some catching up to do, and we just may need to tolerate that a little bit longer to get our economy at an equilibrium where wages are fully fully compensating the workers for the tremendous contributions they make to our economy.
Sheila Bair, always good to have you on the show, former FDIC chair and senior fellow to the Center for Financial Stability. Well, crypto trade surveillance and transaction monitoring firm Solidus Labs finding in its latest report that nearly 2 million investors have lost money to crypto rug pull scams since late 2020. The findings signaling a clear need for crypto regulation in the U.S. Here to dig into the details around the scams is Solidus Labs co-founder and COO Chen Arad. Chen, good to talk to you today. I wonder if we can sort of define rug pull scams, first of all, for those who aren't as informed about this, before we go into deeper dive into your report.
Of course. Thanks for having me, Akiko. It's great to be here, and I really appreciate the opportunity to shed more light on this issue, which is very important for the future of the crypto industry. There's a lot of jargon flying around, so let's clarify this for a second. A rug pull scam originally doesn't have to be a crypto scam. It's essentially a scam where the scammer pulls the rug under the feet of investors in one way or another, basically promises something and then disappears. One of the interesting things that comes out of our report is that when it comes to blockchain-based finance, where the tokens are essentially smart contracts, and again, to remove jargon, smart contracts are essentially pieces of code, scammers can actually deploy on blockchains hard-coded, pre-designed cryptocurrencies that literally has pieces of code in the code that enables them. That means that the investors will never see the money. They basically deploy them, hype them one way or another, wait for investors to deposit money. It can sometimes be as little as $30 to $40 and happen very quickly, or it can even reach over $3 million in the biggest incident. And then once they're ready to pull, they just disappear with the money, leaving the investors with a worthless token. As you've mentioned some of the numbers. Just to reiterate some of the biggest insights coming out of the report we recently released, in addition to the fact that, as you mentioned, around 2 million individual wallets, so individuals were affected, which is, by the way, a number that's comparable to the people affected by some of the biggest collapses in crypto this year. We're seeing a massive increase. So if in 2020, there were around 1,500 of these scam tokens, by 2022, there are already over 120,000 or so, with a new one being deployed every 4 minutes. So again, it's a major issue. It's very important for us to raise awareness about it, and also raise awareness to the fact that there are things that can be done to address it, and it has to be addressed if crypto is to fulfill its potential and become safe and regulated.
And Chen, you're mentioning the speed of some of these things because you in your study saw 15 rug pull tokens deployed every hour. How on earth can regulators keep up with this? It's essentially like playing whack-a-mole trying to keep up with this.
Yes, well, I think it's a very, very good question. And actually, on the one hand, you're seeing here both the massive challenge of open, decentralized, permissionless financial services, but also the huge opportunity. The challenge, because it's, there's no one, when it's a permissionless blockchain, and some of the blockchains that, we identify these on are very important, like Ethereum or BNB or Polygon. If it's a permissionless blockchain, anyone can deploy any smart contract they want on it. You can't stop anyone from doing it. And obviously, as you can imagine, on average, once every 4 minutes, there's some automation done by some of these scammers, et cetera. But, and it's a big and important but, because it's on a blockchain, it's decentralized, it's transparent, meaning that you can scan the smart contracts in the code and detect that it's a scam the moment it is deployed. So you can also, because it's transparent, automate the ability to map these and, raise awareness, prevent the money flows from going into centralized exchanges, et cetera. And I have to tell you, we've had some very interesting conversations with regulators about this. Obviously, the efforts to intensify and accelerate regulation, are increasing following this past few months and maybe year in crypto. And that's definitely something regulators are thinking about. Again, there's a huge opportunity here for law enforcement and regulation as well, because once it's on a blockchain, it's transparent and, you can literally see that it's a scam in the code versus a traditional scam where enough people have to be scammed to report it.
Chen, really quickly, what is the answer from a regulatory standpoint? I mean, we've been talking so much about the fragmentation globally. I mean, this is one of those things, if it's decentralized, it can't just be within one country, right?
Right, 100%. I mean, but look, I mean, the traditional finance is also very globalized, right? And because of that, there's a lot of coordination across jurisdictions between regulators. crypto, decentralized finance, blockchain-based finance is even more inherently global. And therefore, there's already conversations going between regulators globally. Of course, the efforts are focused locally now, but I think regulators are very aware, when you say, that there's a need here to create standards, not just locally, but also globally. The industry is very aware as well. And there's a lot of effort, to improve those standards, deploy better crypto native risk monitoring, and essentially, flatten the playing field in terms of the standards expected of crypto and even DeFi protocols when it comes to protect their users. And again, it's not just out of fear of the law. Of course, that's a big part of it, but also because the people who are building the crypto industry believe that it's really important to enable it because of the potential to make finance more accessible. But today, more than ever, it's clear that all of this potential, to bring sophisticated finance to billions who are currently unbanked will not be fulfilled if the risks are not mitigated. That's what we're here, and we're working with a lot of very, very smart, committed people, including regulators and industry, to constantly improve this.
It certainly does speak to the future integrity of the crypto industry. So we do thank you for joining us. Solidus Labs co-founder and COO Chen Arad, thank you so much for your time this morning. All right, coming up, the FTC is hammering down on Meta as the company looks to expand its footprint in the virtual reality space. We're back with the details on the other side. Meta is delaying its acquisition of virtual reality fitness app Within, an agreement that CEO Mark Zuckerberg made as the FTC alleges that Meta has a, quote, campaign to conquer VR. Yahoo Finance's Ali Garfinkel is here with the details. So, Ali, what's the latest here?
Rochelle, the Within deal has been moved to January 31st, which may not sound like a huge problem, but actually, this deal was originally announced in October 2021, right after Meta announced its name change from Facebook to Meta. And the fact of the matter is the deal's been pushed now a couple of times. It's also notable that this is happening in the middle of this ongoing court battle. It's part of that deal, and it's a court battle in which Mark Zuckerberg actually testified this week. I think it's worth saying also that this is part of the FTC's multi-part attack on Meta. The FTC, remember, is separately trying to force Meta to unwind two previous acquisitions, Instagram and WhatsApp, in a lawsuit filed in 2020. The FTC also didn't stop then Facebook's acquisition of Oculus a few years ago. So ultimately, what does this all mean, Rochelle, right? I'd say it's possible the FTC wins this round. If not in court, they've simply made it too hard for Meta to continue with this transaction. Again, we'll see, but Meta has been indicating it's possible it could walk away from this deal. The reality, though, is still that the FTC has missed opportunities in the past, and I can't help but wonder if they're trying to make up for it now. For me, bottom line, as an M&A reporter, I wonder if they've come down so hard on this deal because of those missed opportunities. And Instagram, WhatsApp, Oculus, those are bigger, more important, and they're also going to prove to be far more difficult to unravel.
Ali, it's worth noting that Meta's growth has really been reliant on acquisitions in the past. You pointed to Instagram, you pointed to WhatsApp. I mean, if they're unable to go through with this and potentially future deals, what does that mean for their growth?
I think it is a huge problem for them, Akiko. I think it cannot be overstated how much of Meta is a renegade acquirer. They're really, really good at finding deals, getting those deals done, and those deals have been key to innovation for them. And the truth is, their Reality Labs innovation hasn't been going well by a lot of accounts. So it's the constant tug of war between trying to acquire new ideas, new technology, and trying to build it themselves. And for Meta, they have been great acquirers, and it's going to be really hard if they can't do that anymore, if it simply gets too difficult. It could hinder their growth in the future, Akiko, I think.
Yeah, certainly going to raise questions about internal innovation there. Ali Garfinkel, thanks so much for that. Well, coming up, Microsoft and Activision Blizzard are moving full steam ahead to seal the deal despite some regulatory pushback. How this could all shape up next.
Microsoft and Activision are pushing the FTC to approve their pending $69 billion deal. Yahoo Finance's Dan Howley has been following the story and joins us now. It has been an uphill battle so far.
Yeah, that's right, Michelle. They've gotten approval in some regions of the world, notably Brazil, but they're facing pushback in the EU, UK, and the US. And their response to the US, the Federal Trade Commission, filing a lawsuit to try to block the acquisition is out. And essentially what they're doing is laying out the same kind of case that we saw them lay out in an editorial earlier this month. Basically, what Microsoft is saying is, look, we're trying to acquire Activision Blizzard. We are the third largest of the three main console manufacturers. Even if we acquire Activision Blizzard for this $69 billion, we're still going to be the third largest video game producer by revenue. So that would be behind Tencent, which is number one, and Sony, which is number two. The big to-do with this whole acquisition is two parts. One is Call of Duty. Activision Blizzard sells Call of Duty. They're the ones that publish it. And it's a cash cow. It made $1 billion in 10 days for the most recent version that was on the market. They have a mobile version. They have a free-to-play version where you would buy skins, and that brings in money for them. So it really is a huge generator for Activision Blizzard. They have other titles, yes, Diablo, World of Warcraft, but it really is the discussion around Activision Blizzard. The second aspect of that is cloud gaming and cloud gaming services. Now, Microsoft has the leader in that with its Game Pass. Its cloud gaming is fantastic on that. I use it regularly. Sony also has cloud gaming. Very good, but the catalog isn't nearly as robust as what Microsoft is offering. Microsoft would use Activision's Call of Duty to bolster that side of things, to bolster its Game Pass and its cloud gaming, make it look far more appealing than it already is, which is, frankly, kind of difficult to do. And so they see that as the future of gaming. They're looking, 15 years down the line, cloud gaming is going to be where it's at. So many people in the world game on their mobile phones or low-powered devices. Not everyone can go out and buy a $500 console. There's a huge market that's untapped from that perspective, and that's what Microsoft is really looking to target here. Sony, on the other hand, is trying to say, look, Microsoft will get too much power. This is a huge game. If people end up only buying Xbox because of this game, it will damage the Sony brand. Now, Microsoft has said that they offered Sony 10 years of Call of Duty guaranteed to be released the same day and date as on the Xbox. Sony has not responded to that or hasn't agreed to that. Microsoft said it's willing to make that legally binding. They've already entered an agreement with Nintendo for that, which doesn't make sense because Nintendo doesn't run Call of Duty. But this is going to be an ongoing battle. And there's discussions on both sides, whether it's good or bad for gamers.
Yeah, it's been a while since Microsoft's gotten this kind of attention from regulators. Certainly going to be interesting to see how they navigate that. Thanks so much for that, Dan. Let's do a final check of the markets before we let you go for the Christmas holiday. We are seeing a bit of a split picture, as we said at the top of the show. The Nasdaq continuing to get hit here, down just slightly though, about 30 points there. The S&P 500 up 7 points, certainly trying to avoid 3 straight weeks of declines, and the Dow up 85 points right now. That does it for Rochelle and I on this Friday. Thanks so much for watching. Wishing you all a very happy holidays.